Our theme is the capital reset. What does all this flux mean for India, for investors, for the markets, capital flows, and for asset allocations? The IMF's latest update projects global growth at about 3.3% for 2026 and sees India growing at 7.3% for FY26. India's own latest projection just out last week is for about 7.6% growth, which is a strong signal of resilience. Yet, at a time when we are seeing the greatest oil supply disruptions since the 1970s, countries opening strategic energy reserves like never before, and the certainties of the past disappearing, the question for this summit today is sharper and more pertinent than ever. In a world of sudden shocks and fast-moving markets, what does smart wealth creation actually look like? That's what we are here to explore today. And I think it would be fair to say that we're living through a period where uncertainty is no longer an exception. It is the operating environment. Although history tells us that wealth has always been created in uncertain times, not in spite of them, but because of how investors respond to them. Now, India today, of course, sits at a fascinating intersection. Never before have Indian investors had so many opportunities, so many products, and so much access to capital markets. Wealth creation in India matters not just for Indians, but for the rest of the world. Just 10 years ago, we were the world's 10th largest economy. We are now the world's 4th largest, having doubled in size and on track to becoming the 3rd largest. Just 10 years ago, our equity market was the world's 10th largest. We are now the world's 4th or 5th largest by market cap, having quadrupled in size. Just 10 years ago, we were doing less than 100 IPOs in a year. Last year, India saw the highest IPOs in the world, about 370, and the 3rd highest IPO proceeds of any country globally at $22 billion, which was more than China last year. But more than the size, it is also the culture and nature of wealth creation itself in Bharat that is shifting at a breakneck speed. I think it's worth reminding ourselves this morning that India has over 21.6 crore or 216 million demat accounts. That's more than the populations of countries like Mexico, Russia, Japan, or the Philippines, compared to just about 22 million in 2014 for context. India's change is being driven also by a new generation of investors. Almost half of assets under management in mutual funds today are now outside of the big 5 cities, and about 1/5 are coming from outside of the top 30 Indian cities. So how do global investors negotiate these breathtaking shifts in Bharat? What are the opportunities and challenges of the Indian markets? What about new asset classes such as REITs and older ones like gold? What's the long-term view on India, and what should investors do? Above all, how do markets and investors navigate today's complex and volatile world where things change minute by minute and tweet by tweet, social post by social post? So at Moneycontrol, it is our business to track these questions on a daily basis. With over 50 million unique users a month and over 1 million paying subscribers, we are India's largest digital financial news platform and among the top 15 digital news platforms in the world. We are delighted to have brought together today a fantastic collection of global investment leaders, fund managers, titans of the industry, and thought leaders to deliberate on all these issues. Later today, we will have the SEBI chief, Tuveen Kanta Pandey, gracing this occasion with a keynote speech. The Gujarat Deputy Chief Minister Harsh Sanghvi will also be here to talk about his vision for growth and investments, along with iconic investors from around the world. We couldn't ask for a more powerful set of movers and shakers to think through questions around wealth and growth in India. And I hope we find as many answers as their questions. Thank you very much for making the time, for coming to the Moneycontrol Global Wealth Summit, and let's have a great day. Thank you.
Thank you, Nalin sir, for that wonderful address. And now we begin with the session that sets the global frame for everything that follows today. Global markets right now are being shaped by several disruptions, as you can see on the headlines, including the wars, the oil shock, the AI-driven productivity reset, and the retreat of the US from its role as the world's guarantor. Some of these changes will pass, and some will fundamentally reshape the landscape. And knowing the difference is what separates a reactive portfolio from a resilient one. So what should investors do? To guide us through this discussion, please welcome N. Mahalakshmi from Moneycontrol. And joining her is someone who has tracked macro, geopolitics, and global capital for 4 decades. So please welcome Jonathan Wilmot, Global Strategies, Alethea Capital, with a warm round of applause.
Good morning, everybody. Thank you, Ravisha. Jonathan, first of all, thank you very much for making this trip to India. And given the kind of news flow we've seen over the last week or so, I was really worried whether you will be able to make this trip at all. But thank you so much for braving this and being and keeping up your promise. Really looking forward to this discussion. So before we get into the thick of the conversation, one interesting, fascinating thing I found is that you've partnered this firm called Alethea, which is what Google named a mathematical equation for an agent in Google DeepMind. Did you or your firm, the partner firm, know what we know now 10 years ago, 2017, when the firm was launched? Or was it just the Greek word unconcealedness or truth that the firm was hoping to do?
Well, I'd like to say that Google are following our lead, which is nearly true. But before I go, thank you so much for inviting me. It's a great pleasure to be here in the world's most populous country, in the country that is waiting to be the next economic superpower in Asia. And another reason for being very happy to be here is that I share one of your religions, namely cricket. I've been a mad keen cricketer since I was a boy, as I'm sure quite a lot of people have been here. And I still play pretty much every weekend in the summer. So I just want to say, congratulations, India. You are the superpower of cricket. So
big round of applause for that, absolutely.
Okay, let's get to it. So, strictly speaking, I didn't found Alethea. I worked with Alethea. I founded my own firm, which is called Wilmot ML. We're based in London. Alethea are based in Hong Kong. But mentioning what Google have just done is actually very pertinent to the subjects we want to talk about today, because their deep think model, as they call it, and which they've called Alethea, has in the last few weeks solved some fundamental problems in mathematics, physics, and computer science, which have defied human scientists working on their own for a long time. And it illustrates perfectly. When I started my firm, I started it because I was convinced even then that AI and machine learning had reached a point of takeoff and would eventually come to be the leading factor transforming the whole of the world economy. And transforming it not in a trivial way, but in a way that was similar to the industrial revolutions of the past. So in a very simplistic way, AI is to human brain power what the steam engine was to horsepower. And we know what the implications of that were in the 19th century. This is a long process, and what Google have just done with their new model is extraordinary, absolutely extraordinary. And it is an example of augmented intelligence, which is the other way that I like to think of AI. And these are fundamental problems in science, which have been solved, and they call it a force accelerator for human intellect. So one of the ways in which you can think about AI is as a force accelerator for human intellect, and as a way of accelerating innovation, discovery, product design, and so on. So when I started my firm, it was the belief that that was going to be the driving force behind transforming the world economy. And it took a while, but now everybody is there.
Yeah, so that's precisely the question. How do you think AI will reshape businesses and economies worldwide?
Well, I mean, you can think of this through various different lenses. You can think of the impact it has on financial markets and who the winners and losers are. We'll come back to that, no doubt, a bit later. But I think of it in terms of macro. It's essentially the foundation for a re-acceleration of productivity. It is the answer for countries whose populations are declining, unlike India, or are cresting. Stronger productivity growth will offset the decline in the labor force. It is, you could just do a simple thought experiment. Everybody here, you've probably seen, heard, read about the affordability crisis that is a very big political issue on both sides of the Atlantic, certainly in the US and so on. Now, what do people spend most of their money on? They spend most of their money on food, especially poorer consumers, on food, on energy, on housing, and then those are essentials. And you could say these days, so is healthcare. Now let's just think what the longer term impact of AI and machine learning is likely to be on the cost of all those things: food, energy, housing, and healthcare. I'm convinced that the effect will be profound in lowering the costs of all those things. So the long run answer to the affordability crisis actually lies in that complex of innovation led by AI. It's not just AI directly, it's the interaction of AI with what's happening in solar energy, say, is the key to the energy side of it. It's smarter farming, it's 3D printing and other technologies that will reduce the cost of building new houses. And healthcare is the one area where you can see the most startup activity and the most innovation going on to reduce costs. I could give you a list of 5, 10 things which are happening only because we have the resources of AI to find innovative, cheaper solutions to things like heart disease or cancer or whatever.
Right. So 2 questions. One is, can you clarify over what time period do you see this playing out? Because that is very critical when we think about it from a business and investment perspective.
Okay. So that's a great point. Like, I'm going to describe this with my hand. So in some respects, the boom in AI infrastructure is driving up the cost of raw materials and food and energy, for example. So if you think of what the end state is, then you think of the price level for these things, it's somewhere down here, and current price level is here. In a sense, the shorter term cyclical effects of the boom in AI infrastructure is to push prices up here before they end up down there. And that's quite important in the current context, as we'll discuss in a moment.
So what does this mean for interest rates? How do central banks, especially the US Fed, react to something like this? Because apart from AI, we are also today, have a situation of war, trade tensions. All of those are suspected, or people fear that it's going to be inflationary as well. So what does it mean for interest rates and central bank responses going forward?
That also is a great question. This is one of the most difficult periods for central banks around the world. But let's focus on the Fed, because everybody, in a way, it's the most important of them all. There is a massive potential internal debate stroke split coming on the Fed. If you are emphasizing...
Jonathan, can you just hold up the mic? Yeah.
Sorry. if you are emphasizing the longer-term productivity benefits of the current technology wave, you're a supply sider, like the new chairman of the Federal Reserve, and you would say there's no need to raise interest rates in the face of a short-term shock to prices that's coming from whatever source, whether it's the war or the boom in AI infrastructure. And if you're a more sort of traditional Fed person, like most of the members of the FOMC, you'd probably think that what's happening now is a reason to raise interest rates. And we don't know yet how that is going to play out. Probably in the short run, nothing happens in terms of rates one way or the other. But that debate between the long and the short-term effects of AI is, I would say, for most central bankers, more biased towards the idea that we raise interest rates. If you raise interest rates at a time of very high levels of government debt interest goes up, you get yourself possibly into a kind of vicious circle of rising rates and rising long-term yields, which has pretty nasty implications for what happens in the rest of the equity market.
What is your thought on AI's impact on financial markets? Because of course this theme in the stock markets has been very strong. There are a lot of private investments, etc., that has happened. So people who believe this is a bubble are simply looking at the amount of money that is going into it, the use cases, whether they will come through or not, whether it will be profitable, what are the payoffs, etc. People on the other side who argue that this is not a bubble essentially say that these are led by companies which are cash generating and so on, and therefore this won't be see the kind of crash we saw during .com. Where do you stand on this, and do you see some sort of a crash or a steep correction in AI stocks anytime in the next 2-3 quarters? How do you see it playing out?
Well, where I stand is that the debate about whether it's a bubble is not useful. What it clearly is not is the same as the .com situation in the 1990s. You can see that currently most of the rise in value of the leading AI stocks, especially NVIDIA, which has been in the vanguard, is kind of one-to-one with the increase in earnings that they have experienced since ChatGPT was launched. There is earnings behind this stuff. If you take the equity market as a whole, there was a huge gap between the level of equity prices and the level of earnings in aggregate back in 1999, 2000. There isn't now. In fact, earnings are further above trend than equity prices, kind of almost the opposite. However, it's just dead simple to say that if we have a shock to the world economy that's big enough to send it into recession, if we have some kind of panic in global fixed income markets and worry about debt sustainability becomes, there isn't going to be any place to hide with this stuff. You're going to see very large declines in the valuation of this stuff. If the Chinese were to invade Taiwan tomorrow, there would be very large declines in the price of this stuff. So it's not necessarily because there's a bubble. And then there's the final issue, but I don't want to go into that right now, which is, are we building too much infrastructure right now that will never pay for itself? Now, that is a very interesting question, but it doesn't have an easy answer. Actually, it is possible that a lot of that stuff will turn out to be profitable, but it probably won't in a situation in which the global economy is in big trouble. So if you have a cyclical downturn,
right,
you're going to have a very significant drawdown in the valuation of technology stocks in general, and the AI stocks may being a higher beta, may go down even more than the rest.
Right. We have a whole session on the Israel-Iran geopolitical conflict and where are we headed on that count. But if you can give us a sense of what is your base case and stress case because of this ongoing conflict. Where do you see crude prices? What does it mean for the global economy?
Well, I don't want to take anything away from Charles's talk, but you're dead right. When any investor, any strategist in a situation which is highly uncertain, you have to have some kind of working assumption. So what do we know for sure? We know for sure that unless we can reopen the Strait of Hormuz within 3, maybe maximum 4 weeks, we'll be in a situation where oil prices could head towards $150, maybe even higher, maybe even 200. So that is the imperative that not just the US, but everybody has to work towards. Everybody's got to find a way. We have to find a way to reopen the straits within 3 or 4 weeks. Looking at that, I kind of think that, well, that's a bit of a 50-50 shot, as far as I know, but the situation is changing very fast on the ground. And it, to some extent, depends on stuff that I can't really predict. So what I do think will happen, I guess probably Charles will say something the same, is that within, I don't know, it may be days, it may be 10 days at the most, I would say, the hot part of this war from the US side will probably stop. Trump will declare victory. But from the point of view of the oil markets, none of that is relevant unless there is a plan to reopen the straits. If we don't reopen the straits and oil prices end up north of $150 a barrel, which in real terms is quite a lot lower actually than it was in 2008, but which helped to precipitate that recession, then we have the ghost of 2008 coming into play. There are credit issues, private credit markets, partly a result of AI stuff. We are at a moment where not reopening the straits is like pulling the plug on large parts of the global economy and then revealing cracks. What do central banks do? What do policymakers do, etc.? So from my point of view, I'm staying relatively cheerful in this sense. I'm not taking for granted that we'll be able to reopen the straits within 3 or 4 weeks, but I'm taking for granted that that is what everybody will work with the US to try to do, and that if they don't achieve it in 3 or 4 weeks, they'll probably achieve it in 5 or 6 weeks. So that at that point, perhaps, if there was a big spike in oil prices, it will come back down quickly. But it would be completely wrong to not see the fragility which is there. We're relying on the fact that it's so important for everyone, including the Chinese, that we'll find a way to get it done. We may not be able to do regime change, but we'll find a way to get that done.
Right. And where do you visualize India in all of this? Because compared to the past cycles, we are a lot more resilient on macro front. Our reliance on crude prices has gone down substantially. Where do you see India in the global trade setup today?
Well, India is going to be, as everybody knows, the largest country in the world in terms of population. If you look at the UN projections for population, by the end of this century, China will have shrunk to somewhere between 850 and 900 million people from 1.4 billion. India will have peaked at about 1.6 and will be gently declining. But the relationship in terms of population between China and the US will have completely switched. You have your own issues about, are you going to be able to create enough jobs for a younger population? Are you going to be on the right end of the AI trade or the wrong end of the AI trade? Personally, I am fairly optimistic about India's potential. I think India will, over the next 20 or 30 years, or 10 or 20 years, become more and more important, both economically as an alternative manufacturing destination, and because I think you will actually do well from the AI trade, if you like. But you know, what do I know? I'm just an Englishman, but I think there are a lot of challenges for India, which are sort of structural, political, social, whatever. But economically speaking, you're waiting to become amazingly significant in Asia and therefore in the world.
Right. Immediately, I mean, within the next 1 year, of course, there are a lot of moving parts. But what could be the immediate triggers for the sentiment around Indian markets to turn? Because like you said, we've been at the wrong end of the AI trade. There were concerns about overvaluation in equities. For multiple reasons, foreign investors have exited India over the last 3 years. Do you see this changing, and what could be the triggers for the change?
Look, I think we're probably arguably, we're in the last sort of 6, 7 years of a long-term bull market which started in 1982. And we've had 2 previous long-term equity bull markets of about 62, 70 years. It's not done yet. I think there is at least one major cyclical decline to come. It could get a lot worse if we don't solve the oil problem even this year. But this is one of the problems that investors, particularly private wealth, have. They always have to balance the difference between growing capital, preserving capital, finding income. One thing you could say about the current environment is, in many ways, it's just like it always was. It's hard to predict. It's bumpy. There's all sorts of conflicting things going on. There's always a tendency to overshooting, exaggeration. But it's probably more difficult now than it's ever been. And one of the things that we're working on, I've been working on for a while actually, is the kind of product I want for my portfolio, which is something which, as it were, you invest in equities, but you can have some way that you switch off the exposure to equities at moments of stress, but you reinvest very quickly. I'm just going to make one comment, because in the context of all this, at the end of the day, we need to know how to manage our money, right? And in my experience, the biggest mistake that people make as private investors is that they get a little bit too carried away when things are good, worrying all the time, but eventually giving in. And then when you have the crash, they take far too long to get back in.
Right.
And so one of the things that we're going to be launching an active ETF in America in May, which is based on a system I've devised using macro signals to outperform equities, in which you delegate that decision to a set of rules backed up in the background by a little bit of AI, that allows you to do that. It allows you to react quickly to downturns. I won't go into it, but the point that I would get at is one of the reasons I run a macro hedge fund in the background for our firm, is that I want something that can make money in down markets. Right. And that's a diversification. Anyway, this is a problem which everybody faces. There's going to be at least one major cyclical bear market. It could be very bad, right, if everything that could go wrong goes wrong now. It could be very bad if China invades Taiwan by force. Now, my working assumption, probably Charles will say more about this, is they won't. There is a graduated set of things that will happen. They will first do some form of quarantine where they insist that anybody who ships stuff to Taiwan by sea has to go through them and get their permission and allow the ships to be inspected. Then possibly they will threaten a blockade way before they did any kinetic war in invasion. But President Xi has said the army must be ready to take Taiwan by force by the year 2027, that's next year. So if we have one of those events, if those go wrong, then things could be very bad. And my last comment on this would be, President Trump is not necessarily that well. Suppose he has a stroke, he's incapacitated, we have J.D. Vance. China's temptation to start with the quarantine system at that point is going to be enormous. So it doesn't matter what you in a way, it doesn't matter what you think about AI in terms of valuation, etc. At the end of the day, right, we face, as we have always faced, the risk of a major shock, whether it's oil, whether it's Taiwan or so on, which completely upends what we do on a day-to-day basis. And we need to be able to think about that and to have a strategy and to have a way of dealing with it if and when it happens.
Right. Thank you so much. Just in one sentence, because we're running out of time. You've seen markets for the last 40 years, ups and downs, all kinds of, market crashes and rebounds. What would your advice to investors be today? Should they be reactive? Should they be proactive? Just in a couple of sentences.
Okay. All right. Number one, go hire a lot of AI agents to help you with the business, but don't, whatever you do, fire anybody as a result. And just recruit them so that you can do a lot more analysis and so on. And the second thing is never forget macro.
Sorry, never forget?
Never forget macro, because for the reasons I've just explained, it doesn't matter what the hell else is happening. If the world has a macro seizure, that will dominate everything else. So,
sure.
Thank you very much.
So much. Thank you so much, Jonathan. Very enlightening talk indeed.
Right. Thank you, Mr. Wilmot, and for your perspectives, and thank you, ML, for leading this conversation as well. But yes, macros is something that we'll be watching out, given that we are in a war situation that is coming in from the West Asia. But before we move on to our next session, did you guys notice a little plant thing which is there on your table? It's just like a tag which is there on like an apparel. So please do take it back to your houses and home and plant it. Remember to click and pick a picture and post it and share it with us. Tag Moneycontrol and IDFC First Bank, and we'll be happy to post it on our handles. So let's spread the message and choose green and choose wisely. So yes, our next session could not have been better timed in a week in which US military actions in the Gulf moved the global markets, and the US Trade Representative launched new Section 301 investigations, which covers about 60 countries, including India. We have had powerful reminders of how US politics directly shapes trade, capital flows, and country risk. And for global investors, decisions made in Washington rarely stay in Washington. So what more can we expect next from the US? To answer this question, please welcome Sachi Trivedi, founder and director, Trident Capital Investments, and for a conversation with someone who has spent 20 years advising candidates in the US presidential, congressional, and gubernatorial races, and is trusted by the world's largest sovereign wealth funds. Please welcome Charles Myers, founder and chairman of Signum Global Advisors. Please welcome them with a huge round of applause.
Good morning, everyone. Founder of Signum Global Advisor, campaign director for Hillary Clinton 2016, Joe Biden 2020, and senior advisor for Kamala Harris in 2024. A wonderful mentor and a great friend, Charles Myers, ladies and gentlemen. Charles, this is your first trip to India. A very warm welcome, and I couldn't have timed this better. So we've got some very hot questions for you. You're actually in the hot seat here. So let's get straight in. Has US and Israel entered themselves into yet another prolonged conflict, endless war, and taking the world with them? How do you think this plays out?
Yeah, so first of all, thank you for the invitation to be here. It's great to be in Mumbai. You know, what I would say on the conflict in the Middle East is a couple things. First, just to make a high level but very important comment, the United States today is at war. The United States is at war. It is a very big deal. There is only one outcome of this war. Iran will lose. I say that factually. At the end of the day, Iran is up against the two most powerful, battle-tested, sophisticated militaries in the world. So if that's the outcome, really the two remaining variables are what does losing, or in the case of the United States and Israel winning, look like, but also the timing. So partly to your question on timing, what I would say is that the kinetic part of this war is likely to be wound down in the next week to 10 days. I even think it could be, you know, next 4 to 5 days. It does not mean the war is over. It just means that the worst of the kinetic part is over. On what winning looks like, if I can, just to say, you know, in any war, winning is two things. It's first defined by the victor, by the winner, and secondly, it's very subjective. What I think President Trump will do in terms of declaring victory is say three things have been achieved. First, we prevented Iran from getting a nuclear weapon. Secondly, we have eliminated Iran's ballistic missile program. And third, we have kept the Strait of Hormuz open. Now, that all may not be true, but that will be the off-ramp. That is victory. One last quick thing on timing and on this war, to your question. There are three puts at the moment that will continue to guide or force President Trump's hand. First, oil above $100, incredibly painful. Price of gasoline up 20% in the United States affects every American household. We have a major election in November. The election's in November, it's already started. The first put is oil above $100 for 3 or 4 days, incredibly painful. The president will seek an off-ramp. Number two, if the 10-year yield goes to 4.5%, we're not there yet, would be another forcing mechanism. Number three, major US casualties, 50 or more Americans, he pivots to off-ramp. But I think we get to an off-ramp in the next week to 10 days.
That's great news. Taking a step back, are the actions in Venezuela and now in Iran ultimately the end game here is to isolate China? Is that what it is? What is President Trump's sort of, strategy with China? And does he have bipartisan support for that?
Yeah, so just on American foreign policy more broadly, actually one other quick thing if I can on Iran. Once we declare victory, again, once President Trump declares victory, as I said, it does not mean the war is over. And I'm here to tell you that the United States is going to occupy militarily the Strait of Hormuz. It'll be a no-fly zone enforced by United States, UK, France, and Saudi Arabian jets, combined with the redeployment or diversion of some of our naval capacity into the strait to ensure safe passage of tankers. We have got to get oil flowing again. So I just want to say that the war will not be over, but at least oil will be flowing again, and it will be a medium to long-term occupation of the Strait of Hormuz militarily by the United States and our allies. On the broader U.S. foreign policy, this is an area where I really think President Trump has been incredibly misunderstood. And it's understandable, but he ran as an isolationist, if you remember, and really said he was going to focus on domestic issues, America first, domestic issues. So again, almost everyone, including in the U.S., assumed he would focus on domestic issues. The truth is, America first was always also going to be about foreign policy, and it's two things: economic nationalism or protectionism, tariffs. And secondly, a much more assertive, aggressive, and I would argue expansionist foreign policy, which includes two main things: the reapplication of the Monroe Doctrine in our hemisphere, and secondly, using military force around the world to address our biggest adversaries. And on your question, what we did in Venezuela, what we're doing in Iran today, I'm here to tell you Cuba is next, and then Greenland. In the end, this is about the United States having much more free access to oil and a lot more oil coming onto the market. Secondly, and very importantly, reducing the influence of China, Russia, Iran, North Korea around the world. President Trump is much more strategic than he gets credit for on a lot. I always say the Trump administration is much more strategic on many issues than they get credit for, largely because of his personality and his rhetoric. But this is a broad America first agenda, which includes expansionism and containing China and Russia.
Great segue into Russia. Now, Russia-Ukraine war enters its fourth year now. And I think it was one of the top agenda items for President Trump. Where do you think that goes? What options does Russia have now?
Yeah, well, look, I say Russia is arguably a loser in a lot of what's happening, just geopolitically. The United States literally just kicked Russia out of Venezuela. There's no other way to put that. They just lost Venezuela. We are going to kick them out of Cuba probably in the next 12 months. And by the way, in terms of tail risk, that's a major risk because Russia's not going to leave Cuba quietly. Excuse me. And then on Ukraine, this is a war that's taken much longer. I think it's been very frustrating for President Trump. Putin is winning the war. I think he's holding out for a better deal in Ukraine. I think he will get a better deal because Trump just wants to end wars. Trump doesn't often get involved in the details. But overall, I would also just on your question about Russia say that in addition to losing Venezuela, Cuba soon, they're not going to get all of Ukraine, clearly. They're a much weaker country and economy. And very importantly, they lost Syria a little over a year ago, and they're losing influence in Iran. Of all of the countries and kind of major military powers around the world, Russia actually is one of the biggest losers at the moment.
Changing tack and bringing the focus to India. I think one of the questions that is really on the top of the mind for people here is, what is our strategic relationship with America? Like, are India and America friends or not? And if you could answer that on 5 levels: President Trump, Republican Party, Democratic Party, corporate America, and then the citizens.
Yeah, so the US-India bilateral, I would say it's very complicated. I think it's always been complicated, by the way. It's just under President Trump, it's a little more complicated. As you will all remember, literally 1 year ago at the IMF meetings, Scott Bessent, actually at the JP Morgan conference during the IMF meetings, on stage said, India will be the first trade deal and it's going to be the best deal. Well, that didn't happen. Really didn't happen. In fact, we barely have a framework today. At least Trump lowered tariffs on India. But several things happened after that that delayed and complicated delayed the trade deal, but complicated the relationship. First, India, to the surprise of Washington, but to your credit, I would argue, really played hardball on trade. Didn't just roll over like the EU did and a lot of other countries. That was a surprise to Washington. Secondly, India consistently has not taken the United States' side in the war in Ukraine, has remained more neutral than Washington would like on the war in Ukraine. Number three, Prime Minister Modi went to Shanghai as part of the Shanghai Economic Cooperation Summit. That did not sit well in Washington. Now, President Trump is about to meet with President Xi, so I'm not here to say there's any consistency in American foreign policy. It's okay for Trump to meet with President Xi, not Modi. But you know, there were some very big issues in the bilateral. I would also throw in Pakistan. And I know we talked about Pakistan in our prep call. You know, it's been very confusing, I think, to a lot of people around the world, including a lot of Americans, this sort of warming up between Washington and Islamabad. You know, what I would, and the fact that the United States and Pakistan are closer today has been another complicating factor in the US-India bilateral, of course. But I would say that on Pakistan, what President Trump is doing is what he always does, which is he will negotiate with anybody and he likes to de-escalate tension. I also believe when he invited the Prime Minister of Pakistan to the White House, it was also transactional. President Trump is incredibly transactional. It's about Pakistan's rare earths. It's about also national security. And lastly, I do believe, I can't prove this obviously, but I do believe there was some discussion between Trump and the Prime Minister of Pakistan that we, the United States, are about to do something pretty big in the Middle East, in Iran, and we either need you on board or on the sidelines. I'm absolutely convinced that that was part of this warming up of the relationship with Pakistan. But President Trump will negotiate with anyone, and I actually would argue that's a good thing.
So in that US context then, who is batting for India? Is it the Republicans, like outside of like, you know, just the White House? Is it the Democratic Party? Is corporate America kind of, you know, being more vocal on fostering some kind of partnership in India?
Well, I think, you know, the US-India relationship is, or support for the US-India relationship is very bipartisan. You know, I think we have a long history of having very good relations with India. India is an incredibly important country globally in its own right, as well as a partner in the United States, where we've, I think, worked very well is around issues of technology, around national security, around space, which is another future part of our relationship with India. But it's very bipartisan in Washington. The perception of India is very positive. And I'm very optimistic, by the way, on the outlook for the US-India relationship, acknowledging some of these areas of tension. So no, and then on the corporate side, to your question, our private sector cares enormously about this relationship. We have a very strong, close economic and other ties that benefit the private sector in the United States. They are huge proponents of this country, supporters of India, but also trying to keep Washington, especially the White House, on track on India.
You mentioned that US would have taken into confidence Pakistan, you know, about the action that they're about to do in Middle East. By the same token, 90% of India's crude oil needs are imported. So this action in Middle East is very critical for the energy security of the country. Prime Minister Modi was in Israel 36 hours before the action started. Do you reckon that this would have been a conversation that Trump or the Israeli Prime Minister would have had with Mr. Modi, or informed him, or put any consideration to the energy security of 1.4 billion people here?
So is your question whether they had a conversation about Iran or what was about to happen? Yeah, oh, absolutely. In the end, the United States and Israel are at war with Iran, but I think that there was probably more preparation behind the scenes with our most important allies, giving them a little bit of a heads up, and there's certainly been some discussion on that. I think for India, as a very big net importer of oil, the good news is that the price of oil looking out to later this year is going to be significantly lower. And I say that because the United States now controls Venezuela, essentially, and which means the United States has unfettered 100% access to the biggest oil reserves in the world. The output, oil output from Venezuela will increase much faster than most assessments. We're taking clients to Venezuela in literally 10 days, 55 clients to Caracas, very huge interest in the oil sector there. But also, we will get to a de-escalation in Iran and probably on a track to a new nuclear deal, or certainly negotiations. And in exchange for that deal, Iran can export a lot more oil legally. We will get to a ceasefire in Ukraine at some point, hopefully this year, more Russian oil being exported legally. At the end of the day, the world is awash in oil. We just need to end some of these conflicts, some of which we've started, but we need to end these conflicts to ensure a much more stable, secure, and ample supply of oil. And I think the Strait of Hormuz will be part of that as well. I'm very optimistic on ultimately the price of oil coming down later this year, which is a huge benefit for your economy. And by the way, a huge win for the United States economy, and a big win potentially for President Trump into the midterms, because he's going to have a very tough midterm election.
If I can drill a little bit more into that. So am I right in thinking that when the war de-escalates, of course, we have, the oil price will come down. But until that happens, if it takes like 2 weeks or 1 week or 2 months, am I right in thinking that US will be accommodative of India getting oil from either Venezuela or Russia, or basically treat India as an ally in this and solve that problem rather than let 1.4 billion people queue up in the gas stations all over the country?
Yeah, no, absolutely. Look, for so many Americans, we have a very vivid and quite painful memory of the oil shock of the 1970s. I'm old, so a lot of us remember it, and it was an incredibly painful time in the United States economically. Ultimately, it's what brought down Jimmy Carter, I would argue, and hurt the Democrats for 2 election cycles. So everybody wants to avoid an energy shock. It doesn't mean the very short term oil can't go to 120 or higher, but just to say looking beyond that. And I think the United States had to act quite proactively, but actually, I would say reactively, and a little fast to allow India to give a waiver to India to buy Russian oil in the last 3 or 4 days, because of how much the US or Washington is worried about the price of oil. So, but to your question, I could see a world or a scenario in the second half of this year where hostilities with Iran are done and we're in negotiation. We may get a ceasefire in Ukraine. Venezuela increases output significantly faster than people project, and the price of oil can come down. So, at the end of the day, we could see an environment where sanctions are lifted on both Russia and Iran, and India can buy as much oil as they want. India does it anyway, by the way, just to say something we all know in this room. But at least that you don't have to try to skirt the sanctions. But more importantly, the amount of supply that will come onto the oil markets looking out to the second half of this year is underestimated. It will be a huge amount of supply. Very good news for India, by the way.
Great. I'm conscious of time. One final question for you. Who's going to be the next president of the United States? Is Trump going to extend his, to his 3rd term? What policies will outlive Trump, and what will, probably go with him?
Yes, but this is my favorite topic. The 2028 presidential election. First, just on the midterms this November, I think that the Democrats will take the House. The Republicans probably keep the Senate. for now. We'll see if we're wrong and the price of oil stays elevated, it will exacerbate the affordability crisis or issues in the United States. And I think the Democrats could take the Senate. But at the moment, I think we're looking at divided Congress. We shouldn't expect much policy change. By the way, as a quick aside, I'm incredibly optimistic on the U.S. economy this year. I think we're going to grow at 3%. Very bullish on the outlook for U.S. equities. I'd be buying the dip here on this risk-off move around Iran, just to put that out there. On 2028, in all of my travels around the world, I've been on the road for 3 weeks through Asia, the Middle East, and Europe. Just got in from London last night. One of the biggest concerns and one of the biggest changes, I would argue, since President Trump came back is that global investors are questioning the safe haven status of the United States. And that's everything from Federal Reserve independence to clean and fair elections to will Trump try to stay in office and get a third term, to your question. And let me say, as a very active member of the political opposition in the United States, I feel very confident that on all three of those issues that we will continue to have an independent Federal Reserve. I think Kevin Warsh was an excellent choice. By the way, I think Scott Bessent's doing an amazing job. I'm really glad he's in the cabinet. And on that note, of the things we care about in this room professionally, meaning the economy and the markets, this is a very technocratic team in the U.S. administration, including Scott Bessent, Howard Lutnick, and even the president. But we will have a clean and fair, free and fair election, and no, Trump will not get a third term. I'm here to tell you that. The third term, however, is something that is not getting enough attention in a slightly different way. The third term, I think, in the aspirations of the Trumps is actually Don Jr., is the son. So I wouldn't discount, I would keep a very close eye on Don Jr. I'm convinced we're going to be running against Don Jr. in 2028. J.D. Vance is the front runner. Trump has twice said he may not endorse J.D. Vance. That's not even code, by the way. That's a direct message to every Republican in the country. It's an open seat. Marco Rubio runs, Nikki Haley runs, DeSantis runs, Ted Cruz, because he can't help himself. It's going to be a pretty crowded primary. Keep an eye on Don Jr. I think the family is keeping a lane open for Don Jr. or Eric as the backup. President Trump wants a third term more than anything. He's not going to get one. The second best is one of the sons. So I think we're going to be running against Don Jr. And on our side, the Democrats will nominate a centrist ticket. I would keep a close eye on Governor Beshear of Kentucky, a centrist Democrat in a Republican state. But the Democratic primary is going to be even more crowded than the Republican one. Last quick point on this. On the Democratic primary for president, what I've been saying is every Democrat in the country is running except for Joe Biden. So name a Democrat, he or she is running. Kamala Harris, Gavin Newsom, Pete Buttigieg, all of them. The AOC is running. What I would watch closely are some of the centrists. I think Governor Beshear of Kentucky, very interesting. Governor Shapiro of Pennsylvania, very likely on the ticket as vice president. You cannot win the White House today without Pennsylvania. And Governor Shapiro of Pennsylvania guarantees, a very popular Democratic governor, he guarantees Pennsylvania, so he may be vice president. But I feel very good about a centrist ticket. I would say that President Trump and the administration have given the Democrats a lot to work with, just objectively. And I'm very optimistic on the future of our politics. I'm very optimistic on the institutions in the United States holding. And I'm very optimistic about the Democrats coming back and taking the White House in 2028.
Well, so the key message is oil prices coming down dramatically in the second half of the year. Trump wants Nobel Peace Prize and the third term as a president. Great note to end this. Thank you, Charles.
Thank you.
Okay, all right. Charles, thank you so much for bringing clarity to a market that is being increasingly shaped by policy before price. And of course, we've had some good headlines which is coming in from this conversation where Don Jr. can also be the next running presidential candidate. But yes, Thank you so much, Sachi, also for moderating this discussion. And now we'll be moving on to domestic portfolio question, the one that's keeping every fund manager up in this room at night. And we've seen that Indian equities have spent the last 12 months frustrating both the bulls and the bears. So the question has been, where is the right alpha right now? So yes, sir, let's find out in the next discussion. Let me invite back N. Mahalakshmi back on the stage. And please put your hands together for our distinguished speakers. Sunil Singhania, founder, Abacus Asset Manager. Joining him is Rajiv Thakkar, CIO and Director, PPFAS Mutual Fund. Maran Govindaswamy, Executive Director and Co-founder, Unify Capital, and Sridhar Shivaram, Investment Director, Enam Holdings. Please give them a huge round of applause.
Thank you so much, gentlemen, for making this dream panel come true. On a Saturday morning, thank you so much for joining us. Whatever this panel of four men say is going to have a bearing on this Monday morning opening. They're all sought after fund managers and very astute, delivered outperformance for many, many years, seen many, many cycles. The markets have sold off nearly 3,000 points from the top. And for all this while, we have been talking about this conflict. In fact, for 3 years, geopolitical conflict has been seen as a risk. But, and for known risks, we usually say that the markets know this risk and therefore it's not a big risk. But even so, whenever a risk plays out, it brings in fresh uncertainties like we are seeing today. It's not just the price of crude, but the availability of gas that is dominating the conversation today. How does that impact not just oil stocks, but also something one would not have imagined, like a stock like Eternal? So the first question is, what is the unknown part of this equation? And therefore, what is the downside from here on? Let's start with Sunil. It's on, I think. Just speak.
Good morning, Mahalakshmi, and thanks, Moneycontrol, for having me. Fabulous setting. It's an immersive experience. Frankly, you know, the way last week has gone, I was so relaxed that Saturday, Sunday, I will be completely switched off from equities. But here I am again talking about equities. So I think, frankly, you know, multiple headwinds we have faced, but most of those headwinds were becoming tailwinds over the last 15, 18 months. You know, economy was coming back on track, corporate profitability was coming back on track. The tariff issue was more or less, you know, sort of sorted, at least reduced in terms of intensity the way it was at the peak. But out came this joker of the pack in terms of the Iran conflict. And conflicts are never good, and more so when, you know, it is in the region where India gets impacted the most because of its reliance on crude. Having said that, obviously, you know, when these things happen, there are reactions, and logically so. We have seen the emergence of massive FI outflows. In fact, February was a good month. FI flows had started to become positive, but there has been sudden risk off. And obviously countries like India, which got hit because of oil and consequently the currency also take a beating, have seen a major brunt. Emerging market funds which were receiving inflows have started to receive massive outflows. And for a change, I am also seeing a lot of nervousness among Indian investors also. And it was very evident last 3-4 days where even the you know, sort of stable companies like banks and Larsen of the world and all falling 10, 15, 20%. So I think it's a phase where you need some kind of good news. And I wish that what was said in the panel before, or in the session before, that it's in the last 4-5 days and we should see some good news. I think war will de-escalate sooner than later, but we need very, very decisive good news for the the markets to sort of find its bearing. Obviously valuations have corrected, so that is a little bit of a comfort, but markets can swing more than fair value on the upside as well as on the downside.
Rajiv, if oil were to correct, or this conflict has to escalate, what do you see markets playing for? Do you see a rebound of sorts? And if it were to deepen, do you see the market getting into a more bearish consolidation phase for the rest of the year?
It's quite difficult to predict. So that's the reason why we keep telling people come to equities only if you have a 5-year kind of horizon. Near term, the headlines can swing markets either ways. As was mentioned in the previous 2 panels, it's a certainty wars will end somewhere. No one is clear on the time frame. Will it go on for a week? Will it drag on for months, maybe a year? So no one knows that. But people will adjust. Luckily, for India, oil is not as big a component of the overall economy as it was, let's say, in the 90s, where oil shock would completely derail us. Foreign exchange reserves are plentiful in India. And the world also has a choice. So while we are seeing disruptions on the cooking gas front and maybe a disruption to the petrol diesel kind of ecosystem down the road, but luckily the world has alternatives in terms of electric mobility, and so world will adjust. I don't see a problem there. The problem that I see is everything looks like a crash, but all said and done, we are roughly 12-13% from the peaks that we saw. This is not like COVID, where let's say 35-40% correction happened, or like 2008, where maybe 50-60% falls were there from the peak. Also, starting valuations were not very conducive. So we have had a 2-year kind of flattish market, time correction and price correction in the small and mid cap space. So we are somewhere near moderate valuations on an average. Now, average hides a lot of things. There are pockets of overvaluation still, and there are pockets where attractive valuations are emerging. Like Sunil said, there's no law which says market will stabilize at a fair value. It could fall significantly. So market goes to extremes. So that is the worry. Choppiness will be there. So people should come to equity only if they have a longer term horizon. And the other worry that I have is a big section of the investors today have not seen a sideways or a downward market. They have always been taught to buy the dip and things normalize in 3 months, 6 months time. If it continues longer, then some of them will lose hope.
Madan, you and I have spoken about this, average conceals the valuation discrepancies that you see in the underlying. And the last time we spoke, you said 10 to 15% of the stocks are essentially below the, long-term averages in terms of valuations. Has that equation really changed? And therefore, for the overall broad markets, how much more downside do you see in a stress case scenario and in the best case scenario?
It's tough to put a number, but to a specific question, what percentage of markets are at, say, investable zone from valuation perspective? Over the last 1.5 years, most of the conversation among fund managers, investors, and when we meet the investors, center around macros, geopolitical events. Many of them were not so relevant in the context of making a longer term investment. valuation divergences in market, which always exists. In every market you will find that, but the degree of divergence, especially over the last 3-4 years, has been sharply higher. That led to more than half the companies in major benchmarks being super expensive levels. And that's getting corrected, but it hasn't got corrected to a level where you can say majority of the stocks are in the investable range. But to put a specific number to your question, what otherwise would have been 15-20% of the market that were investable maybe a few months back would have become 5-10% more. Right. But still, you may find almost half the markets you can't justify based on current valuations.
Right. Sridhar, do you see any hiding places? Because I think you have a similar view on valuations. In this sort of an uncertain environment, do you see any hiding places? Should you hide inequities at all, is the first question.
So there are no hiding places, as Sunil also mentioned that, if we are going through a geopolitical crisis right now and nobody has a clue. I mean, your earlier panelist also.
Put the mic up.
Yeah. He also mentioned that, we really don't know when this war ends, how this thing plays out. But I also want to put a context that, the Asia is going through an earnings super cycle. So when we see FIs selling, what we need to keep in mind is that Korea earnings growth is going to be 100% this year. Taiwan is going to be 30% plus. Even China is having 15 to 18% earnings growth. So when earnings growth comes back in India, specifically the the large cap, we will see FIs come back. We will see the markets come back because stock markets are to some extent slaves of earnings. Our own view is next year earnings will come back. We don't know how this geopolitical thing affects the earnings, but if you assume that it doesn't last for too long, earnings comes back, then large cap specifically does look like a space which should do well in line with earnings. That's how I would put it.
Right. Maran and Sunil run mutual funds, which I don't know your strategy, but most fund managers tend to say that we take whatever money comes into equity funds as a given and try to be fully invested at all times. But Rajiv is more dynamic with respect to asset allocation. So in this sort of a market, as a tactical bet, would you much rather increase your cash position, sit on the sidelines? Because they say that in bearish scenarios, it's good to have firepower, dry powder to be able to fish when the market really cracks. And like Maran said, that we have only seen 15% down from the top. Would that be your strategy, or is this time to just sit with whatever you have and watch, or would you liquidate some of your, would you take profits, would you cut losses, what would you do?
So I have no view on the direction of the market. I don't know what will happen on Monday. Will it be sideways, upward, downward? If I get adequate opportunities to deploy, I would be happy to deploy to the last rupee that I have in the portfolio. It is just that after we deploy in companies that we like, sectors that we like, given the weightages that we are comfortable with, whatever remains, we stay in cash. That hasn't meaningfully changed for us in this. So at the margin, of course, we have been buyers, but it hasn't meaningfully changed things for us. But things are starting to look interesting. I think if markets continue to fall for some more time, I think we'll be close to fully deployed. Not yet, but maybe somewhere down the road.
Right. Sunil, you are a growth at reasonable price sort of an investor. In this market, are you looking at buying opportunities? Of course, with your new fund, you will have to deploy, but where do you see?
No, I think definitely stocks are cheaper than what they were 18 months back, and in fact, more cheaper over the last 1 week, 10 days. And the other thing is the impact cost is now no more there. So it was very difficult to buy stocks in good markets. The moment you go to buy, the stock just used to move. Now it's basically a buyer's market. The other thing is, I think Sridhar mentioned about earnings growth. In fact, we were getting very positive on the earnings growth cycle. December earnings growth were pretty good. The Nifty earnings growth were upwards of 10%. The broader market companies grew 15 to 19%. And things actually are actually falling in place. If you see the January and February data points also, car sales, retail sales, steel sales, cement sales, they have all been trending up. Now, there is going to be a near-term disruption for sure, not only because of oil prices, but because of also supply chain disruptions. But these are the times when, you also get opportunities. And I think particularly in the broader markets where now we have reached a stage where the seller doesn't care about the price and is just dumping, I think I would say that this is a much better time to start to create portfolio than it was maybe in the last 6 to 18 months. And,
any particular pockets that particularly look attractive to you?
So I think, see, financials, great sector. Stocks, particularly for larger banks, have fallen a lot. Some of the engineering companies, I think stock prices have fallen a lot. We like pharma, though in this current correction, pharma has been resilient. But if we get an opportunity, we like a lot. But broader markets, smaller companies, I think that is where we see, much better opportunities than ever before. We typically don't like to keep too much cash unless the view is that the markets are going to fall by 25–30%, because that cash decision is already taken by the investor. Investors are already doing STPs or SIPs. On top of it, if we also do cash, then maybe, it might be a double whammy for the investor if the markets move up. And frankly, no one knows. As Rajiv said, we don't know whether markets will open up or down. But I am very positive that this conflict has to end sooner than later. And I would say that the way crude prices have moved up and the way the supply is responding, it is possible that when things settle, oil can be significantly lower than when the conflict started, and which can be great news for India.
Right. I'm just looking at, some of the stress sectors today. For example, the oil, the entire oil pack, the city gas distribution and all of that. And Rajiv, I saw that you've made some purchases in that. So does this, the businesses that are stressed because of this ongoing news, are there any pockets that are now, looking very attractive in terms of valuations and warrant a very compelling buy?
I think this is even before the war thing started. I think one of the big themes in the market has been sell anything relating to software and IT services, and where AI will do everything end to end. While it's true that headcount needs may reduce or there will be productivity gains, I am in the camp that people will still be required. It's not that a few prompts will get you the entire piece end to end. And somewhere the IT services space will start to look attractive. So watching that space closely.
Okay, Sridhar has a completely contrary view on that. Please go ahead.
Yeah, so I think this is a view we've had for more than 2 years, that this sector is getting disrupted because of AI. It doesn't mean that the disruption happens tomorrow or day after. As we've said, that this is a derating event, as we saw with the media sector. 10 years back, OTT came, and did the media sector completely vanish? No, but their valuations are now in single digits. So the starting point for the IT sector was actually even worse, because when AI has come in right now, their growth rates have been very moderate in the 3 to 5% range. And the valuations were very stretched, not commensurate with the growth that they were giving. We think that they will continue to derate. Now they have corrected so much. Is it possible that it moves up in the short term? I don't know. But if I take a 3–5 year view, is AI going to disrupt? The answer is yes. How much? I don't know. Will the valuation derate? I think the probability is very high. So that's how I see. Are there some opportunities in the small cap? Maybe. But I think the large cap companies, adoption of new disruption by an incumbent, they're generally very slow. I think it will be very difficult for the larger IT companies to adapt to these changes. We'll see how it plays. I would surely stay on the sideline.
Just a couple of minutes more, and anybody can take this, but I'll pose it to Rajiv, because you're rooting for IT and saying that it's looking like a good space. Because like he said, top line growth is 3 to 5%. In this whole, AI story, people say that even if they have productivity gains, all of it will have to be passed on to clients, and therefore bottom line growth cannot be faster than top line growth. And the base valuation is not cheap. I mean, even I think from 2014 to 17 or 18, valuations were lower than what we are seeing today. So what is the case?
So I think Benedict Evans has written a wonderful nuanced blog post on this. And he talks about something called the Jevons paradox, where when something becomes cheaper, people start using more and more of it. So cell phones, for example, 16 rupees a minute was the call rate, and then things became very cheap. Number of subscribers simply exploded. Or banking, for example, earlier ledgers were written by hand, cash was dispensed by people sitting on the counter. The question is, do we have more employees today in the banking sector, or did we have more employees in the banking sector 30 years back? Answer is we have more people employed in banks today. So more and more software needs will come to the fore once productivity becomes that much more. That's my understanding of it.
Maran, what is your hunting ground today? And are there pockets of stocks which are perhaps just 10% away? Because it doesn't take too much for the market to go down 10%. I mean, a couple of weeks of bad news may take it there. 10% away from what you would think is compelling valuation. Pockets.
There are pockets. There are pockets. One thing we should avoid doing today is to trying to make sense of whole market in a overgeneralized manner.
Yeah.
Maybe we got used to periods like 21 to 24 when you had a broad market move, and that move came with very low standard deviation. Over 3-4 years, we had much higher than long-term average returns, but at much lower than long-term average standard deviation. Such periods usually will be followed by periods of lower than long-term average returns or higher than long-term average volatility, or both. At this point of time, instead of trying to make sense of whole market, if you are looking at certain pockets, maybe in the last 6 months, 9 months, even before the recent correction, there are pockets of market which are much cheaper today than what they were, say, 3-4 years back. For good reasons. Either there would have been some earnings disappointment, or some inconsistent earnings, or uncertain future. Within that, if you can find few pool of ideas, this is fantastic time to invest.
So what are those pockets? What are you looking at? Higher than average growth, lower than average valuations.
It's easy to ask, but tough one to state. But I think there are few pockets. People like you try to make sense that in terms of sectors. But we should be conscious of the fact that some of these sectors, which were extremely homogeneous in the past, like IT services, may not be so in future. So you may find a very different outcome within that. But there are few businesses like financials, which are not in the expensive pocket of the market. They are cheaper today than what they were 3-4 years back. Pharmaceuticals, they are cheaper. But there are a whole lot of businesses which you can't just... I think this mic is off. Yeah. So you will find a significant sectoral rotation maybe in the next 3 to 5 years from now. We have been having it over a period of time. We don't notice it. What was maybe steels, cement, textile, power were 60-65% of the industry when I began my career in 91. And in 2001, we had probably 40% of the index market cap being in IT, and financial services in single digit. As recent as 2020-21, we had almost 40% BFSI. Are we going to have similar weightages, similar sectoral representation, say 10 years from, 5 years from now, 10 years from now? We are not going to have it. So it is better to not to take a sectoral call and instead focus on valuation. And there, be agnostic to the market caps. Today, it's tempting for people to say small mid caps are expensive.
Right.
But within that, you find quite a few interesting opportunities. And some people may say large caps aren't that cheap. But if you look closely, maybe 35% of the large cap earnings are in single digit companies, which means the balance 2/3 of the large caps are much, much higher than what the index is showing. So there are pockets, but instead of trying to make sense of that in an over-generalized manner,
Right.
or through a sectoral lens, or through a market cap lens, it makes sense to go back to the basics of valuation and see the opportunity.
Got that. I mean, this is a conversation that will go on in Moneycontrol every day, day in and day out. Half an hour is too short to sort of, map the whole market and say where you should be buying and selling. But thank you so much, gentlemen. All of you, please stay tuned to Moneycontrol and this conference for more conversation. That's all the time I had on this panel. But thank you so much, gentlemen.
Appreciate it. Thank you.
Good morning, ladies and gentlemen. Good morning to this audience, and what an interesting discussion we've had out there. So I'm wondering, how is the audience feeling? How's the Josh? Gold, silver, crypto, real estate? Any ideas? Any thoughts? Equities is really getting the audience, I think, thoughts out. We have a lot more lined up for you. Thanks very much, Mahalakshmi and the panelists there. Fantastic session. Now, before we move on, just a quick reminder. If you want to share your key takeaways from the Moneycontrol Global Wealth Summit 2026 on social media, please do click post, but remember to tag us as well and use the hashtag MC Global Wealth Summit 2026. Do tag moneycontrol.com. And also, just another quick reminder, a little planting for the future tag is there on your tables. I'm sure everybody's seen it on your tables. Please do take it back home, plant. It's a lovely Sunday tomorrow. You can use that time. Remember to click a picture and do, again, share it with us, tag Moneycontrol and IDFC First Bank, and we'll be very happy to post it on our handles. So let's spread the message, going green, green for the planet, green for our portfolios. We all are looking for a little bit of green in life, right? So if you, by the way, if this tag, if you can't find it on your tables, then do collect it. It's also available at the registration desk. So make sure green is the color we want on our planet, in our planet, and obviously in our portfolios. Let's move on now, ladies and gentlemen. With India going through a remarkable financial transformation, millions of new investors are entering the system. Digital payments are becoming second nature. Few leaders now have had a front row seat to this transformation, like our next speaker. He built Capital First from scratch, merged it with IDFC Bank, and has spent the last several years transforming it into a modern digital retail bank serving over 40 million customers. Ladies and gentlemen, please welcome on stage V. Vedanathan, MD and CEO, IDFC First Bank, with a huge round of applause. Mr. Vedanathan, if you could hear a few words.
Good evening, ladies and gentlemen. It's really a great pleasure for me to talk to all of you, and this is one of the probably only second time in my life I'm doing a speaking at an event where it's all around 360-degree view. First of all, since I'm one of the early speakers, I'm trying to just set the context of the overall numbers that we're dealing with in the country when we talk of wealth management as an opportunity, but set the context. So India's household financial assets in the country is about $19.3 trillion at this point of time by multiple research numbers. Of this, the financial services household wealth, okay, financial services, that is about $4 trillion. And of that number, let me just share with you, where is that money? So this is about 22 to 23% is in financial assets. Now, this number, about 5 years ago, was 18%, about 10 years ago. So you can clearly see that financialization is growing, and the rest of the number, X this number of the 19.3 minus the $4.3 trillion, is basically physical assets. Could be property, which is the largest, gold comes next, then physical assets like consumer durables and other watch, pen, all the kind of physical assets people own. That's about 80% or maybe 78%. Now, of this financial asset of about 350 lakh crores to 400 lakh crores, 150 lakh crores is in bank deposits. Now, don't confuse this with bank deposits stock in the country as we report, we normally call it 240 lakh crores. But I'm saying household bank deposits, okay, household bank deposits. That's about 150 lakh crores. Equity, good estimates are about 100 lakh crores. Mutual funds, about 50 lakh crores. Again, don't confuse this with mutual funds of 80 lakh crores we talk about. We're talking about household mutual fund holding over 50 lakh crores. And then EPFO, pension, etc., all that 45 lakh crores, you get the drift. So a large part of the Indian ecosystem is still in bank deposits, but you can see clearly that mutual funds and equities growing very well. Let me just share with you, in the last 10 years, the bank deposits have grown by 2.6 times to reach the 240 lakh crores today. Now I'm talking not household bank deposits, but total bank deposits. So total bank deposits have grown 2.6x in the last 10 years to reach this 240 lakh crores. The total mutual fund investments has grown 7x, 7 times, to reach about 80 lakh crores. The total PMS market, portfolio management services, that has grown 7x to go from 1.5 lakh crores to 11 lakh crores. The AIF market has grown again 12x from 1 lakh crore to 12 lakh crore. You can clearly see that bank deposits has grown by 2.6 times, but everything has grown by 7 times to 11 times. You can clearly see money is moving to investments. But this is not something that should be surprising. Then I went and checked out data for other developed countries as well. Like in the case of US, for example, and many other developed countries, what we are saying bank deposits, household bank deposit about 50% or so, this number is about 15% or 20%. So as the initially, like all of us, I'd say 90% of the people in this room also, maybe one generation ago, our parents would have probably earned maybe a lakh a month, a lakh a year, or maybe 2 lakhs a year. But today you can see people earning maybe 50 lakh, 60 lakh crore a year, depending on which income level they are, maybe even 20 lakhs. So you can see that big shift has happened. And after the basic need of keeping money in savings is required, people do move to investments. People do move to investments, which is why as income is growing, you can see clearly where the story is moving. So, and this is also fueled by the fact that huge amount of entrepreneurship is coming in the country. Any case over the next 5 or 10 years or so, you will see serious movement in entrepreneurship in data center. And with data center will come downstream entrepreneurs like your maybe cooling systems, maybe wiring, cabling, real estate that is coming for data center. You see the drift about everything will create its own. Similarly, renewable energies will come. That will create its own ecosystem of entrepreneurs. A semiconductor industry will come. That will create its own downstream entrepreneurship ecosystem that will come about. Space will come, AI will come. So these are new sectors coming up. Everything will create its own, entrepreneurs, micro entrepreneurs, and so on and so forth. And that also creates wealth. Big amount of intergenerational wealth will also happen. Compared to past generations, this generation has made a lot more wealth. It will get transferred to the next generation, and they will all need financial advice, wealth management, and so on. So if you see broadly, the people, if you think of a pyramid like this, and think of people at the top, they usually are getting all support. They are getting mutual fund advice, they're getting AIF, they're getting PMS. I speak to many venture capital funds these days, $100 million, $200 million funds. Everyone is telling me my fund is making 15% CAGR, 20% CAGR. Where is all the wealth going to? They're all going to top of pyramid, because who's investing there? Only top of pyramid people are investing there. When you come to, let me say, middle segment, in the middle segment, one level below, these are people earning probably maybe 20 lakhs a year, 30 lakhs a year, 40 lakhs a year. They probably invest in mutual funds. They get kind of advice. I don't think they're getting high quality advice which fund to invest in, etc. But they just they go by. If you come, but they have some wealth, not great advice. If you come below the pyramid, people earning 15,000 a month, taxi drivers, rickshaw pullers, this is a large population of India. They neither have money, they have very marginal saving, and they don't get advice for sure, because no bank can afford to do it. But My point is, I'm going to show you in a quick demo about how this advice can go down the pyramid in a very quick way, and my colleague here will just put it up. So now, what we have done is that is the screen coming up? Yeah. So what we have done is we have tried to create something called wealth management for all. This is very important because we also admit it's not possible to give a 40 lakh relationship manager to somebody keeping 20,000, 50,000 rupees in the bank account. It's not, economics don't work. Because remember, behind every relationship manager meeting a customer, there's a large number of people who are behind the scene working to make it happen. They are the portfolio research people, they're the analysts, the operations people, the compliance people, technology people. A lot of people are working behind. So one RM supported with so many, all that cost comes to load to service a customer. We all know that. So what we have done here is that we have created something called wealth management for all. You can see on the top, left-hand side, wealth management for all. So now we say, click on wealth management, and then you say that, you go here and you say, look, if there's a customer who doesn't know their own risk profile, they say, they don't risk profile. So they say, I'm not sure. So here they come and say, look, how dependent are you on your investments? Okay, partially dependent. For time horizon of 3 years, how comfortable are you if you're of high risk, high returns? You say, I don't know, maybe I'm not comfortable, or yes, I'm comfortable. And then you say that if you win a lottery and all your money was if you want to invest, where would you put it? Let me say debt and equity. So through all these processes, you get a sense that this customer is a balanced investor. So these are digital tools. So you say, okay, I want to make an investment. And then based on the fact that you are a balanced investor, now the system is then throwing up, say, a bunch of funds for you, which is a deep research that has happened behind the scenes, the same number of people, but instead of serving 20,000 customers, it is serving, let me say, 20 million customers. So dramatically equation changes. And then you're in a position to say, okay, what is this fund that is recommended by the bank in this case? And then you say, you can see what is the performance of that particular fund. You can see what are the market cap of the companies it is invested in, what are the companies that particular fund is invested in. And then you see the companies you feel comfortable. Then you come and say, okay, what are the scheme details? And then you come and say, what is the risk of this fund? You can see risk of this fund is something like this. You say, fine. And then you say, I want to make an investment. And then you say, okay, invest now. And then you get an OTP, you submit it, you verify, and this investment is done. So this is a digital process of giving wealth management to below the pyramid, because whom we cannot afford through the relationship manager process. And it works, by the way. And let me now take you back to say that if this customer, one of the big things India has achieved is to create the account aggregator framework. And with the account aggregator framework, you can see the top right-hand side, we got something called the My Net Worth. So in the My Net Worth, you can click on this, and this particular customer whom I'm referring to here has a net worth of, say, 23 lakh rupees. And this person can now see what is the savings accounts I have across the ecosystem. In this case, let me say this person has account at State Bank of India, and then so on and so forth. And then, the person says, okay, what are my stocks I'm holding? And similarly, what are the mutual funds I'm holding? And then you get the drift. And then you can say, what are the EPF? What are the fixed deposit across the system? And so on and so forth. So this ability to bring the entire ecosystem together through the new digital ecosystem India has created and make it available through, you can see in a single screen, this person could see their investments across mutual funds, EPFO, stocks, fixed deposit, bank balances, everything. Now you can do high quality analysis on this based on on-off data and off-us data, and then give high quality research to the common people, which you would have normally brought through relationship managers to the top of the pyramid. And this is something that is a new agentic ecosystem that is going to come up in AI. This will make a very big difference. Because again, in today, when a relationship manager meets a customer, I told you there are a lot of operations happening behind, and you're serving 200 customers or maybe 70 families. Its economics don't work. But with the arrival of AI, this research can go and check, agent can go and check what are the news articles about the subject. It can give a full look through of what are the stocks you're holding based on the multiple mutual funds you're holding. It can probably go and do a tax assessment for you. Another agent can go and see what are the GST changes. Another agent can go and see what is happening in the oil market today or what's happening. So there are many multiple agents can operate in the background, very low cost compared to human beings, bring it together and give high quality research. Therefore, when today wealth management is available at say 5 crore plus or a private banking with a relationship manager, same quality research. I use the word same quality, not the lower end quality. Same quality research for a 5 crore rupee customer, what you're getting high quality can be made available to somebody keeping 10 lakhs with the bank. And that makes a very big difference. Not even 10 lakh, could even go below that. So that is the power AI is bringing to this digital ecosystem if we embrace it to the whole ecosystem. I don't mean the conversational capability, which also can be the next avatar of it. Because conversation, like a RM talks to you, like that the conversation, it can never be as high quality as a human being really talking to you, but you get the drift, get somewhere close. So this is one very important thing that India should be moving ahead in this ecosystem. I want to just finally conclude that this agenda of, because what is happening is that the rich will continue to become richer because they will keep earning 15% plus compounded. If they put an AMY, PMS, they will become maybe getting 18%, 20%. But bottom of the pyramid is just beating inflation through savings. They will never make wealth. So this rich-poor divide will only increase if we don't find high-quality digital tools to fix this issue. And today, fortunately, with the digital ecosystem, availability of Aadhaar, the entire bureau and the whole digital India ecosystem India has put together, plus the arrival of AI is a massive opportunity if we absorb this opportunity and take high quality research to the bottom of the pyramid. Now, I want to just conclude by saying that there are a few things that we still need to improve. India has built this phenomenal architecture today of depository participants, registrars, a fantastic regulator who's looking at it so closely and so on, and regulating it, and the time coming down from T+3 to T+2 to T+1, paper going away. That is like something phenomenal India has created. All of you will talk about it, I'm sure, all day. Now, this is a massive thing that is actually enabling things going down. In the previous ecosystem of paper, there's no way below the pyramid would have been serviced. So the cost of funds coming down is also because of a market mechanism India has created and a settlement architecture and so on. But even today, if you see the porting of a customer from one wealth manager to another is quite complex. You take a physical paper, you send it to some RTA, and they take 15 days to make it happen. In today's digital world, it should not be like this. Because you can move a bank account, you have two bank accounts, you move money instantly. You can even port mobile number, quickly. But you can't port a wealth customer today so easily. It takes 15 days to make it happen. So this is something that, it will improve competition. It will improve, service levels. This is something India should look at. And finally, of course, when we look at, the growth of the wealth management ecosystem, fortunately, a large number of players have now come into the game. Banks are providing wealth management. These new age broking firms are providing it. Standalone wealth companies are providing it. So this ecosystem has come alive, which is all bringing it together. So I'd like to bring this to a close. Since we are associated with the program, I'd like to share with you very quickly about IDFC First Bank. I'll just take a minute to just share with you that we are ourselves a big beneficiary of this being created in the new digital ecosystem bank. The person who spoke to me introduced me as saying building a digital bank. I truly tell you, IDFC Bank is building the bank on 3 fundamental principles. We are saying new digital ecosystems come. We are born in a new age. So I showed you how we can do, I did a demo. We say we want to be ethical banking, so we really make that in a tagline. We want our employees to imbibe that. And third, we say, simple products. I want to tell you that in the last 10 years, 6, 7 years alone, you can see our wealth management grown from 1,000 crores to 58,000 crores. And that's like you can see how it's growing. And then we kept it very simple. We said zero fee banking. We said 6.5% interest above 10 lakhs. And then we said monthly compounding, and below 10 lakhs, we pay 5% above 1 lakh. And then we say monthly compounding interest. We keep it very simple from the point of view. We try to put a bunch of services for the customers, which we think are, complete in terms of wealth management proposition. And, we put together a bunch of credit cards, we take out all complexity, etc. But the point is that we are experiencing whatever we're building, we are experiencing it, that customers are loving it, numbers are growing. But the main thing is that we are ourselves following this concept of taking it below the pyramid and dropping the thresholds or giving the same quality what we give for a 5 crore plus customer to somebody even keeping maybe 10 lakhs. And that is our agenda we're working with. And that will truly expand it, particularly with the growth of the Indian market ecosystem, digital ecosystem, and the market, and the extraordinarily fantastic market infrastructure India has put together. And I must close by saying in the last 10 years or so, India has truly built something quite remarkable in terms of all the participants, the wealth managers, the regulator, etc. we talked about, and my really heartiest compliments to anybody, all of you who are participating in building this big ecosystem for the country. So thank you very much, all of you, and really nice talking to all of you. I'm really so happy the regulator is here with us, and thank you very much. All of you are doing a really wonderful job for all of us. Thank you.
Thank you so much, Mr. Vaidyanathan. That was a very, very interesting session, very interesting thoughts as well. And obviously, financial services has become an increasingly complex and perhaps increasingly competitive landscape here in India. And technology and digital obviously is the disruption and the opportunity as we go forward. Well, we also have our guest of honor here with us, and in the next couple of minutes, we will be hearing from him. We're talking about the capital markets ecosystem. We're talking about keeping investors' trust and faith intact, and that is what our guest of honor, of course, really embodies and symbolizes. So in the next couple of minutes, I think we'll have Nalin join up on stage to welcome our chief guest. But in the meantime, as we're just getting ready for that session, let me ask the audience. So how's the Josh this Saturday morning? I think it's only high on my left. I think my right is not feeling it. Oh, someone on the back, I think. Okay, so once again, I go back to the question I asked before this session, before Mr. Vaidyanathan came up. So equities, bonds, crypto, commodities, precious metals, real estate, come up with what you want. This side said equities. What's the right side saying? Multi-asset. Someone's saying cash. So okay. So I think we have mixed views over there. So? Phygital. Okay. Okay. All right. Okay, let's do a riskometer. Volatile markets, the last 1 year has never been, perhaps more challenging in a while, since COVID for sure. We've had the trade disruption thrown at us. We've had the AI disruption thrown at us. And now we're dealing with a full-blown war in the Middle East. So riskometer, how are you feeling? It's a feel factor or an emotion factor riskometer. On a scale of 1 to 5, let's see a show of hands who feel that the fear factor is at, say, 7, 8, or 7 or above. How many people feel that there's a lot of fear and they want to go down on risk? Show of hands. Who want to curtail risk in their portfolios? Not too many, actually. Okay, a few hands over here on this side. Okay, and how many are willing to go all in and use every opportunity to buy? There we go. I think the bulls have it. The bulls have it for this one. Thank you, audience. You're very, very spirited. Thank you very much. And without further ado, now let's get ready to welcome in our guest of honor, Nalin. If I could please have you on stage.
Thanks very much, Surbi. Capital markets, of course, rest on a very simple promise: fair information, honest price discovery, and a level playing field. Upholding that promise is the role of the capital markets regulator, the Securities and Exchange Board of India. And right now, the agenda is as complex as ever, from the surge in retail F&O trading to IPO pricing and global capital flows, and of course, the impact of the war. Ladies and gentlemen, we are privileged to have among us today the man holding it all together, a beacon of stability in a world full of chaos, the chairman of SEBI, Mr. Tuhin Kanta Pandey, sir. We at Moneycontrol are very fortunate that you kicked off the inaugural Global Wealth Summit last year in your first public speech after taking over as SEBI chairman. And we're delighted that you're back this year at the second edition, sir. We are very honored and grateful, sir, for your presence. Ladies and gentlemen, Mr. Pandey has been India's one of the most distinguished civil servants, an IAS officer of the Odisha Cadre of 1987. Before joining SEBI, he served as the Union Finance Secretary, the Revenue Secretary, and the Secretary Department of Investment and Public Asset Management, also the Department of Public Enterprises and DOPT. He's also served in the Regional Office of the UN Industrial Development Organization and holds a master's degree, sir, from Chandigarh University and also from an MBA from the University of Birmingham. Sir, over to you, sir. Everyone is waiting for you.
Good morning, everyone. It's a pleasure to be here today with this distinguished gathering of leaders from finance, business, policymakers, media, and the wider ecosystem. I would like to thank Moneycontrol for bringing together such a diverse gathering of participants. Today's theme, making capital markets more efficient in uncertain times, is both timely and important. If we look at the global economic landscape today, one word appears repeatedly: uncertainty. Technological change, particularly the rise of artificial intelligence, is reshaping industries and business models across the spectrum. At the same time, geopolitical tensions continue to influence economic relationships. Conflict in Middle East has massively disrupted energy supplies and created volatility in oil and gas markets across the world. Inevitably, capital markets have been severely impacted. Yet, when we look back at similar episodes in the past, one lesson becomes clear. Periods of extreme volatility never last forever. In the recent past, we have witnessed the disruptions caused by COVID-19 pandemic, followed by the Russian-Ukraine conflict, which had triggered market volatility across the world. Markets experienced turbulence, but they eventually stabilized. Even today, while the ongoing tensions in parts of the world have created uncertainty in energy markets, global efforts are underway to restore stability. For many investors, especially retail investors, the best strategy may be, during such period of high uncertainty, to remain patient. Markets today operate in a very different information environment. Capital flows now respond not only to economic fundamentals, but also to rapid shifts in sentiment, information, and narratives. This raises an important question. Can markets remain efficient when uncertainty itself becomes the norm? Or perhaps a more relevant question is this: are markets designed to function efficiently despite uncertainty. Because uncertainty, as history tells us, is not an exception in financial markets. It's a recurring feature. The real test of a market is not whether volatility appears. The real test is whether the system continues to function smoothly, fairly, and efficiently when it does. Efficient capital markets play a stabilizing role in an uncertain world. They enable transparent price discovery. They help absorb shocks without destabilizing the broader financial system. And perhaps most importantly, they sustain investor confidence. Efficiency is the foundation of trust in the financial system. Without that trust, capital hesitates, investment slows, and growth becomes more difficult to sustain. In fact, the true test of efficiency is not in theory, but in how markets evolve and perform over time. India's experience over the past decade offers a compelling illustration of this evolution. India's capital markets have expanded significantly over the last decade. Since FY15, our market capitalization has grown at a CAGR of about 15%. The corporate bond market has expanded steadily at a CAGR of around 12%. The primary market has remained an important channel for capital formation, facilitating around 9.7 trillion rupees of capital raising annually. The number of unique investors in securities market has grown at roughly 21% CAGR, indicating a broadening investor base and a rising household participation. Mutual fund AUM have expanded at over 20% CAGR. The AIF ecosystem has witnessed rapid expansion, with investments growing at more than 50% CAGR, channeling capital into startups, innovation, and emerging sectors, and so on. These numbers tell an important story. India's capital markets are no longer merely expanding. They are deepening, diversifying, and becoming increasingly resilient. But as markets grow in scale and complexity, they also become more closely connected to global developments. And that brings us to the changing landscape in which today's market operates. The environment in which our markets function is evolving rapidly. One important shift is economic fragmentation. Trade corridors are changing, supply chains are being restructured, and investment flows are responding to these shifts. Another major transformation is driven by technology. Algorithmic trading, artificial intelligence, and advanced data analytics are accelerating the speed at which markets operate. Liquidity conditions are also becoming more episodic. Global capital flows can move quickly across geographies. But perhaps the most striking change is the velocity of information. News travels quickly, opinions travel even faster, and most importantly, markets today react almost instantly to the narratives. And therefore, the question before policymakers and market participants alike is, how do we ensure that speed does not compromise stability? In recent years, SEBI has undertaken a number of initiatives to strengthen the efficiency of markets ecosystem. We have reduced the settlement cycle to lower the settlement risk and improve operational efficiency across the market. To strengthen debt ecosystem, thresholds from electronic book mechanism have been reduced, and the scope of EBP platforms has been extended to include REITs and InvITs. In a measure aimed at further facilitating capital raising and easing minimum public offer requirements for larger issuers, the central government just yesterday notified changes to SCR rules. These changes allow companies to list with different levels of initial public float, consistent with adequate liquidity, and provide a longer phased timeline to achieve minimum public shareholding requirement of 25%. We have strengthened the AIF ecosystem with lower thresholds for LVFs, large value funds, and strengthened the framework for accredited investors. For global investors, our effort has been to make access simpler and more seamless. Measures such as simpler regulations for IGB-only funds, introduction of common contract note, Swagat FI framework, relaxed block windows, all are aimed at enhancing ease of doing business and bringing in operational efficiency. Another area of our focus is how can we increase investor participation. To improve the investor access in debt market, we have reduced the investment threshold for privately placed bonds. Issuers are permitted to offer incentives in public issues of debt securities. To promote greater participation in mutual funds, distributor incentive structures have been revised. For NRIs, certain KYC requirements have been eased, facilitating smoother participation in Indian markets. Our efforts are underway to further simplify the investor onboarding processes by enabling enhanced information sharing through KRAs. While expanding participation, investor protection remains central to the regulatory framework. Tools such as validated UPI handles and SEBI check enable investors to verify intermediary accounts in less than 30 seconds before making payments. Monitoring of social media platforms help identify misleading or manipulative content. Initiatives such as Parva are helping standardize and verify performance data presented by intermediaries. With an aim to strengthen the governance standards and accountability across the ecosystem, we have taken several measures like mandating external independent performance evaluation for our market infrastructure institutions, designating compliance officer in regulated entities as key managerial personnel, strong emphasis on independence, diversity, and accountability in board composition, mandate for regulated entities to dissociate from unregulated entities that make unverified claims on returns on performance. These efforts aim to ensure that market development remains anchored in transparency, accountability, and investor trust. However, efficient markets cannot be built by regulation alone. They require the collective commitment of the entire ecosystem. Listed companies must uphold high standards of governance and disclosure. Intermediaries must promote a culture of compliance and integrity. Institutional investors must contribute to responsible market development. And market infrastructure institutions must continue strengthening resilience and operational excellence. Efficient markets are, in essence, a shared responsibility. As India continues its economic journey, capital markets will play an even more important role. The next phase of development will require deeper bond markets, stronger institutional participation, and continued technological innovation. Today, capital markets are moving from supporting economic growth to shaping economic growth. Ensuring that this growth remains transparent, resilient, and efficient will be one of our most important collective tasks. Let me conclude with one final thought. In uncertain times, the strength of a capital market does not lie in the absence of volatility. Volatility is a natural feature of markets. The real strength lies in the confidence that the system will function fairly, transparently, and efficiently, even during periods of stress. If we continue to strengthen our institutions, deepen participation, and uphold governance, India's capital markets will not only navigate uncertainty, they will emerge stronger from it. And that is a journey we must pursue together. Thank you, Jai Hind.
Thank you so much, sir. Thank you for your thoughts and for an inspiring speech. And I must thank you, sir, also on behalf of the entire investor ecosystem. It is thanks to SEBI that those guardrails are in place. It is thanks to SEBI that this market has evolved. It has become deeper. The systems are in place to ensure that while volatility comes and goes, the market simply goes on, whether on the way up or on the way down. The regulatory environment has ensured that our market continues to be a very, very vibrant one. So that's, of course, as far as regulation is concerned, the evolution of our market, and where we are, ready to compete with any global stock market or equity market or securities market around the world, all thanks to the structures that we have built and the way the regulators have kept our ecosystem safe, and they've kept investor trust at the center of it all. All right, ladies and gentlemen, with that, we have to move on to our next session. Now, we're talking capital markets. When the history of India's capital markets in this decade will be written, I'm sure that the IPO chapter is going to be a very, very colorful one. Record issue sizes, anchor books filling up in a matter of literally hours, retail participation touching record levels. And, we've seen listing days that have become reminders that euphoria and price discovery are not always the same thing. The opportunity ahead is enormous. The global ECM pipeline for 2026 could approach, as per some estimates, around $2.25 trillion. Now, how much of that India captures and how these deals are going to be structured, how will they be priced, how will this capital be allocated to public investors, that will determine the shape, the credibility of our market for years to come. To take the next conversation forward, let me invite on stage my colleague, Ashwin Mohan. Ashwin. Now, a lot of you will know Ashwin. Ashwin is the deals man of Moneycontrol. Every now and then, you have to be on our platform to get the latest breaking story when it comes to deals. But how's the mood now, Ashwin? Since market is almost in a funk.
Well,
but how's the deals mood?
Well, thanks, Surabhi, for that rather generous introduction. And good morning, everyone, and welcome once again to the second edition of Moneycontrol's Global Wealth Summit. Surabhi, you were asking me, how's the mood? Well, as a deals reporter, ye dil mange more. Think deals, think Moneycontrol, and we sincerely hope the purple patch continues. But clearly, the world has changed in the last 2 weeks, right? We saw the last quarter of 2025 was a sizzling quarter, more than 10 billion raised via IPOs, but now the entire IPO market is facing the entire impact of the West Asia crisis, right? And that's obvious. And that's something that we're seeing panning out because activity is slowing down. But yeah, go ahead.
But I suppose that is part and parcel of volatility. It's part and parcel of the news flow and the challenges that are getting thrown at this market every day. But I think structurally, so much has changed. Domestic institutions coming in, participating, owning so much of equity assets in the country. And I don't want to take more time because I know that you have a fiery panel lined up to discuss all of this and more. So take it away.
Absolutely. I'm not going to waste any more time, and I'm going to invite our stellar panel on stage one by one. These are men who have seen various market cycles, gone through various ups and downs when it comes to the life story of the issuers. And they've also taken some of the creme de la creme of firms public as far as Dalal Street is concerned. So without further ado, let me invite on stage V. Jayashankar, MD and Deputy CEO at Kotak Mahindra Bank. Atul Mehra, MD and CEO at Axis Capital. Abhinav Bharti, Head of India ECM at JP Morgan. And of course, from the PE point of view, one of the pioneers of Indian private equity, Manish Kejriwal, founder at Kedara Capital. A round of applause for all the panelists. Right. Be fearful when others are greedy, and greedy only when others are fearful. The man who said this wasn't exactly a big fan of IPOs. I'm referring to the legendary market investor Warren Buffett. But this was his mantra during times of market volatility. And as it looks like, that's exactly the unpredictable and challenging scenario that is staring at me as well as the panel, because we now have the rather brave task of dissecting the roadmap as far as the Indian IPO market is concerned, going ahead in 2026. So without further ado, let me go straight into the conversation. Jaya, let's start with you. More than 140 companies have regulatory approvals to go ahead to raise more than 1.6 lakh crores via IPOs. What's the mood right now on D Street? Can we safely assume that it's wait and watch mode for all the major issues? And is the strategy now to perhaps wait for stability, wait for light at the end of the geopolitical tunnel, take a check from the investors later on, and then plan ahead?
Yeah, firstly, I would say that the overall IPO momentum has been the strongest in the current year as we began in January compared to the previous 2 years. There were probably, as you said, 160 filings. If you look at the number of IPOs that happened in the last 2 years, it's been on average 100. So there is certainly a great degree of optimism in terms of quality. We are seeing the quality only getting better and better. So I think structurally everything is in place. Obviously, no one expected the Iran-Israel-US war situation.
That's right. It came like a bolt from the blue.
But as some of the fellow panelists said before this session, markets have a way of turning around very quickly. I mean, you look at the Russia-Ukraine war, probably the markets were disrupted from a IPO point of view for a period of, call it 30, 45 days. It had both the tech meltdown as well as Russia-Ukraine war. The COVID situation disrupted the capital markets for about a month and a half. So markets will bounce back pretty fast. At least there seems to be a consensus that the war will probably enter a low intensity even if it continues. Markets need to find that stability. But I think deal making will happen.
But are issue launches getting deferred, Jaya?
It's a pause. I wouldn't say getting deferred. It's a minor pause. We are just waiting for that little bit of stability.
Right. So when the going gets tough, the tough gets going. Atul, why don't you chip in over here? What's the feedback that you're getting from IPO investors, both domestic as well as overseas? And how does the pipeline look like?
Okay. So can I set the context a little?
Please go ahead, Atul.
Flashback. Whenever we speak to investors, and investors can be of any type, foreign institution, domestic, private equity, or a man on the street. There were 4 common concerns which came up. And what was the first one? Geopolitical, Mr. Trump. The second concern that came up was the prices are too high. It's very expensive market. Number 3, valuations are stretched. Okay, number 4, FIIs are selling. These were the 4 common excuses which were given to us. Now you have an adversity, which is an opportunity. What has happened? The prices have corrected. Okay, valuations are looking much, much better, much, much reasonable. Okay, and we all know that this war is not going to last perpetually. Most of the experienced people believe that if not over, it will be substantially over in a very, very near future. So I see this as a great opportunity in an adversity. What do we need? We need a little bit of 3 or 4 things that need to happen. And this is what the investors are telling us. Number 1, as they say, long live the king. I rephrase it to say long live the SIPs. As long as the SIPs survive and we have the inflow, I think the domestic mutual funds are in a very big way. They are not shying away from investing. Number 2, you will see a lot of cash-rich corporates whose stocks have taken a beating because of no reason. They will step in to do buybacks in a very aggressive manner.
Right.
So you will see support coming in from there. You will see friends like Manish, Kedara, and other private equity rolling up their sleeves, sharpening their pencils very quickly, and coming down with their shopping list to invest money, because this is a great investment opportunity for them. And what are the FIRs telling us? They are liking the correction in the market. They are liking it. Unfortunately, they are seeing redemptions in the emerging market flow, which is the only concern that they have, because they are not the principal, they are the agent. When the money goes out, they have no choice but to sell. Therefore, they are reacting. To my mind, we should not read too much into it. As Jay said, I will rephrase it. This is more of a dislocation rather than a fracture. Okay, this will get corrected very quickly, and we have past precedents which points towards us. Just a matter of little bit of courage, little bit of conviction, and you're home and dry.
Sure. Manish, I'm going to come to you in just a minute, but let me just address the third banker on the panel. He struck a very optimistic note. Abhinav, tell me, and the audience would like a candid answer, are there any super gutsy firms out there that may perhaps take the plunge even during these uncertain times? You know, I'm reminded of the market debut of Mankind Pharma back in April 2023, right? Exactly. Jaya and Atul are smiling because both of them are on that mandate. Now, Mankind Pharma launched when nobody expected anybody to launch an IPO. It came on the back of several weak retail listings. The pharma segment was down. So tell me, any super gutsy firms out there, Abhinav?
So there are a few, without naming them, but the most important point I would make is, at the end of the day, periods coming out of these volatility, we have seen the firms that get priced their IPOs deliver the best returns in the long term. Mankind Pharma was one example, but if I roll back a year prior, 2022, on the back of Ukraine war, we had a 3-4 month lull. But when the IPO market started and you had small deals, 1,000, 1,500 crore IPOs, each of those companies have done very well. So point number 1 is that the reset of valuation, because IPOs are always a derivative of where the secondary markets are. You have seen a reset of valuation in the secondary market, it will flow through into the primary markets. Primary markets are always driven more by what I call it as the VIX index. So VIX going above 20, you will see the issuance going down, because nobody will be issuing paper when stocks are going up and down every single day. You want stability more than the level of prices. So going back, there are quite a few firms lined up. And more importantly, as the secondary market stabilizes, you will see them coming back much faster. In a pipeline of 160 odd filings, there are quite a few high quality names that will come to the market this year. in my view, you will again see a situation where the long-term performance of those IPOs should be very stellar, similar to the names you highlighted.
Right. So key takeaway is that IPOs are not in cold storage. There are a few that have just merely pressed the pause button. Manish, he struck a very optimistic note as far as private equity firms and their appetite in such a market is concerned. How do you view the exit environment from your PE lens?
First, Ashwin, thanks for having me here. Good to be here. I didn't know it was going to be such a large audience, so congratulations.
Indeed, a pleasure.
I don't intend this to be a one-on-one on private equity, but I just want to put a little bit of context from an investor's eye, which is very different than most people in the room because we do private equity, not public markets. We're not marked to market every single day. So we actually have a huge amount of luxury and our time frames are much longer. When Ashwin calls up, kya deal hai? He needs to fill out the paper tomorrow. I smile because we have a 10-year product. So there's no rush for us to do anything.
And I have a 24/7 monster to feed.
Sorry?
And I have a 24/7 monster to feed.
So the beauty about our products is, please understand, firstly, we have to be humble and recognize the power of the markets. And whether you have an IPO that you're selling in or buying into, respect the market because it will always humble you, right? So what do? For us, understand as a private equity player, the largest competitor when we are in buying mode is the markets. It's not any other private equity firm. You try to convince a promoter to take a stake, help him. If the market is trading and roaring as it has been, good luck. He would rather take his company public. Whereas on the other hand, when you're selling, your market is your best friend. So broadly, and I'm coming to your answer, if I look at the last 1 year, what had we done? We had put the brakes, not brakes, but we had slowed down investments, but we had really accelerated exits. As recently as 2.5 weeks ago, and Jay and a few others were involved, we sold down $500 million equivalent of stock in one of our larger companies which we had listed called Vishal Megamart. We still sold down something more last week. So I'm just saying, at times like this, it'll be great. The prices have not, what this gives us is a chance to actually deploy more capital, assuming, unlike what Atul is saying, the war is extended. I don't want it to be extended, but if the war is extended, there should be a correction in pricing in the private markets, which is always 3, 4, 5, 6 months after the public markets. And that's a healthy thing because the markets are unsustainable as they were as a buyer 6 months ago or 3 months ago. So the correction is good, but again, in our mode as a buyer, obviously our selling, I always say I'd much rather be lucky than smart. And we're lucky we sold out. We couldn't predict the war was going to happen.
Right.
And that's our worry, where we focus our time as private equity, is not kharidna hai, bechna hai. We have great friends like the three of them here on stage who help us do that. For us, the real time right now is, given what's going on in the war, what's going on in AI, how does that influence our companies? Is that a good thing or a bad thing? And for each of our companies, the only thing we're focused on is how do we maintain revenue growth, hence EBITDA growth. Exit, there will be a time. If the markets are closed for the next couple of weeks or months, it makes no difference to our life at all.
Sure. Quick question before I come to Jay. When are we getting the next Vishal Megawatt from the stable of Kedara Capital?
You know, I think Jay and Atul will know that better than me.
Jay, we have spoken about launches being on pause, but let's now talk about the forward outlook, right? Let's talk about fresh pitches, fresh filings. Which are some of the most active sectors that you see at Kotak in terms of fresh pitches and fresh deals? And a quick follow-up question. Hyundai, LG Electronics, Tenneco, now I believe beer giant Carlsberg is also in the works. Will the MNC IPO wave continue? Your thoughts?
See, the thing I would say about the Indian capital market is it's very resilient. And it's very resilient because of the pretty strong domestic institutional flow. And there is certainly a valuation arbitrage for most of the MNCs when they look at their own parent valuation and the Indian valuation. So it's only natural when they start looking at capital allocation globally to probably invest here. So if you look at the sell down last year in terms of blocks, about $30 billion were sold, out of which roughly a third were by foreign MNCs. And it's a capital allocation issue, and some of it probably happened through the IPOs as well. So I see that trend certainly continuing. The reason why they also look at India for a listing is because India is, after all, a growth market. In most sectors, whether it's consumer or otherwise, you find the Indian growth opportunity and therefore the valuation being superior. So this trend will continue, but having said that, it is not going to gallop in a fast way. It will be a steady secular trend. That's my view.
And quick take on MNC IPOs?
They'll continue.
Especially where there's scale and size.
Absolutely, absolutely. It will be more strategic decision by the MNCs to list in India. It is not just a question of taking advantage of valuation arbitrage. It's a more thoughtful, strategic decision. Some of them want to be seen as a more of an Indian brand.
Indian brand, right.
So those are other factors that play in. So it's not going to be just one of a valuation arbitrage.
Right, point taken. Atul, a few years back, there were no takers for instruments like REITs and InvITs, right? Indian issuers also did not have the option of confidential filings. Now confidential filings are picking up steam. It's not just the new age companies, but the non-new age companies also that are adopting the route. Give us a sense of the appetite for REITs and InvITs going ahead, Atul. And don't you think confidential filings are very flexible and are perhaps beneficial for a company when you might just change your plans?
Now, both of them are valid question. Let me first address confidential filing. Confidential filing is a great leeway which has been given to us by SEBI. When I say us, the entire capital market by SEBI, it achieves many things. In a situation where your data is confidential and you don't want public to have a dig at it, but you want regulator to clear it, I think confidential filing comes very handy. And two, when you have a certain regulatory challenges which are not meeting the guideline, you can do confidential filing and it helps you to buy time. So that's a second big advantage. And third big advantage, as you rightly said, I may change my mind. I may do, I may not do. So it offers great flexibility. For all the three reasons, we are seeing many companies, many issuers, many private equity investors opt for a confidential filing. So that you're going to see increased number over a time.
And quick take on REITs and InvITs and the demand?
So REIT and InvIT, I am most bullish on. Okay. We just concluded one transaction last evening. Okay, Rajmark. You will, if I tell the numbers or if you would have seen the numbers, it will blow you out. Okay. It goes to show the depth of the Indian capital market. It goes to show how many investors are willing to buy this product. And by the way, 10 years ago, when we did the first REIT and InvIT transaction, we had to explain the product to the investor. Today, investors have understood it so well, they are buying it. So I am most bullish on it. We have seen this market grow 10 times in the last 4 years. 10 times growth in last 4 years. This is the fastest growing segment within the capital market. And look at it, objectively, we need two types of companies. Companies which take the development risk, which we called as the DevCo company, and we have the REIT and InvIT companies where their build out assets are given to pension funds, insurance companies, all the ultra high net worth individual who want steady return. So it's a great product for them. And when I was talking of Rajmark, we had 10 pages of anchor list flowing down in terms of investor. And again, I'm happy to say even our regulator, SEBI, participated as one of the anchor investors in that. So the product is now gaining tremendous acceptability across every category.
Right, so Atul's made his point loud and clear. He is very bullish on REITs and InvITs. Of course, we have a very proactive regulator that has done its best to adopt global best practices. But coming to practices and processes, right, Abhinav? As a deal maker, ye dil mange more, right? So give us a sense of perhaps some of the aspects which the Indian regulator can adopt, which are present in overseas jurisdictions, but may not be part of the current SEBI setup, whether it comes to book building, whether it comes to how much skin anchor investors have in the game. Can you illustrate with a few examples? In fact, Hong Kong also last year changed the rules of the game.
Correct. So I would say, look, for IPOs, the thing that is most important is flexibility. The ability to have a flexible regime so that you can react to market changes. Remember, an IPO process is a bare minimum 2 to ideally 4 weeks that you are stuck with a single valuation number, whereas the market can go up, down, and you have to try and book build there. That's the single biggest challenge we face. So the biggest benefit if we can provide is how much more flexible we can make the process. Now, of course, the regulator has continued to work on that path. The minimum public shareholding, the minimum float required upfront, the rules that came out last night are all in that same direction.
Right.
But just to give you some examples, despite the way the markets are, in the US right now, you are still seeing IPOs getting priced. In fact, just earlier this week, a Japanese company listed in the US called PayPay, raising about $900 million. They had the flexibility without changing the issue dates to actually price their IPO $1 below the range, change the price, the number of shares or ADRs being issued. So those flexibilities in a public book build process allowed for a transaction, a cross-border situation to get listed in the US, even when the markets were so bad. So that's just a very recent example. I'll give you another example, and you talked about Hong Kong. Hong Kong has this concept called clawback for retail. And the way it works is it actually makes the retail a more positively biased in the direction of how the book building is happening. So every IPO, for example, will start with, let's call it only a 5% retail tranche and a 95% institutional tranche. There's no HNI equivalent there. And then depending upon fixed number of subscriptions for retail, that retail tranche could actually expand to become 50% of the IPO. In other words, in a hot IPO, retail gets more. In a not so hot IPO, where you want institutions to actually own the stock and so that they could hold it for the long term, they actually take the more. So it becomes more aligned with how you want the stock to get concentrated in the
And these two aspects you think will go a long way in giving more flexibility to Indian issuers. Well, we can only hope the government and the regulator is taking
away from
note.
retail. If retail shows up for our deals,
absolutely,
they will absolutely get their full 35%. But equally, when they don't show up, you don't have the stigma that, look, the book wasn't subscribed.
Very, very interesting submissions, Abhinav. Manish, give us a sense, are private equity firms now warming up more to dual track processes, wherein you simultaneously pursue an IPO and at the same time you're also trying your luck with a stake sale? That's number one. It's a two-pronged question. And the second one, how challenging is it for a PE firm like you in the current environment to maintain the key metric of DPI, distributions to parent capital? At the end of the day, that's what matters to your LPs, right? Go ahead.
Second one's easier, and the two are interrelated, of course. The fact that we sold down 500 million in Vishal was cognizant of DPI, but not DPI for ourselves. You've got to think actually ahead. Creating DPI in these times is more valuable because our investors, if you avoid for a second the domestic, our investors firstly are global institutional investors who've had a huge shrinkage in liquidity because of what's happening in the rest of Asia, especially China. So they're very, very scarce of capital right now. So an additional dollar from us is worth a lot more than normally. So we shoot for DPI. The beauty about India today is DPI, there are three engines for us to your dual process. One is, of course, the IPO markets. And thanks to the domestic investors, SIP, large mutual funds, it's been on fire for the last 2 years. We also have a very active sponsor market, which is private equity firms buying and selling from each other. We sold one company to Warburg, another packaging company to Advent, one more financial services, Avas, a listed company recently to CVC. So there's a very active secondary market. When the market falls right now, the pricing in the secondary market, sponsor to sponsor, because of the liquidity in the market, is significantly higher. So you're right. That's the second one. The third one, which also for India is becoming critical, is strategic buyouts. often companies globally are looking to mark India now as a pivot away from China, or they started with the Japanese 20 years ago, but now it's becoming commonplace. So those are fewer and far between, but you're still seeing many of those. As a PE investor, when we're looking at a company, we don't decide today, market this thing, let's do something else. That decision was made an investment. I don't allow an IC to be evaluated unless the team at the time of investment has a very good perspective on who the natural owner should be. Is it the capital markets? Is it a strategic? Is it a sponsor? And actually, the IC won't pass it until we get the names, if it's number 2 or number 3.
That's right.
My only point is, so it's not a knee-jerk reaction to what's going on in the... Our team would have had 3 options, worked on the most probable one, and frankly, if the market is as it might get to, so I don't want to be rosy all the time, this could get to a real amount of gray for the next 6-7 months. You know, we then say we defer the sale, because again, remember, we are a 10-year product. But the discipline of exit should be such that you realize the money 3 months ago, not be forced to selling today.
No, fair point. You know, gentlemen, we're approaching the end of our panel, but Jay, I'll leave the closing thoughts to you. Any key dominant theme that you would like to point out for the rest of the year when it comes to IPO activity? And secondly, we've also seen the market regulator, SEBI, intensifying its scrutiny of draft papers, right? There's a lot of intense scrutiny. There are a lot of questions being asked. There's a lot of focus on quality disclosures and compliance. So your quick take on those 2 aspects.
See, obviously, this disclosure standards, because of our regulations, is really high. We have seen some of the MNC clients really commend our market, saying that perhaps the disclosure standards here, due to its focus on retail investors, is perhaps even superior to the developed world. So that is one thing which really stands out about India. The second thing I would say is the depth of our capital market is really strong. I mean, if you look at the last 5 years and take the top 10 companies, I think they would have probably raised through secondary IPOs as well as blocks anywhere between $20 to $30 billion. I mean, Vishal Megamat that Manish spoke about, they have done about $3 billion in 15 months. Mankind, you spoke about $2 billion in 15 months or 18 months. So that's the kind of depth that is there for quality companies. And that is what keeps us excited. Structurally, I think India is in a great place.
Well, audience, you can sense the optimism on stage. Atul, Abhinav, Jaya, and Manish, thank you so much for your rather candid thoughts. With that, we have come to the end of this discussion. Hope you folks enjoyed it. Thank you so much.
Thank you. Thank you.
Thank you, gentlemen. That was a very interesting one. I think it's very, very clear. Global capital, local capital, it will be here and it will chase assets, which is why the deals market, the kind of assets on offer, the pricing, it will always be extremely at all points in time, offering plenty of opportunities for investors, depending on, of course, their individual desires. With that, let's move on. Now, India has an estimated 8 to 10,000 family offices managing over $30 billion. This number is growing faster than probably most of the other Asian markets. That brings us to our next discussion. Inside India's family offices, the new playbook for private wealth. Let me call my colleague Chandra Srikanth on stage to talk about this. And then, of course, she's got a full panel of experts with her. Of course, Chandra is no stranger. She's a lady who spoke to President Trump at Davos. So, you know, we'll always remember that as a highlight.
And the trade deal happens, Surabhi.
Exactly, yeah. So that was Chandra at Davos. Chandra, I can tell you this, that, you know, as someone who tracks the market, family offices have become such a huge force to reckon with. Of course, there'll always be the debate about whether people should be entrepreneurs and focus on building businesses or building family wealth. But, you know, that debate continues. And I'm sure you'll be discussing that and more with your set of experts and panelists.
Right. In fact, all of them are sitting right here. Some of the biggest family offices in the country, who I dare say are giving Ashwin speakers a run for their money, private equity funds and venture capital, because these are not just token checks anymore.
Yeah.
They are investing in the private markets. They are investing in the public markets. They are making overseas acquisitions, and they are setting up offices around the world. So India's family offices are going places.
They've really come of age. So take it away. Let's call the
Thank you very
panelists.
much. And it's always challenging, to stand between a session and your lunch. But I promise you, this will be very appetizing, a lot of interesting takeaways, not to mention a lot of money on stage. It's my absolute pleasure to welcome Rishabh Mariwala, the founder and managing partner at Sharp Ventures. Rishabh, please come up on stage. We also have Deepak Padaki, the president of Catamaran, which manages Mr. Narayan Murthy's funds. We have Shekhar Garissa, the MD and CEO of Claypond Capital, which is Ranjan Pai's family office, and Venkat Subramanian R, which is actually the newest family office on the block. He's a CIO of USK Capital, which manages Uday Kotak's wealth. Thank you all very much. Thank you, Rishabh, Deepak, Venkat, and Shekhar. So, the previous panel had the bankers, but you guys are the ones who will sort of put money on the table and cut those deals. But before I come to each of your family offices and their approach, I must ask you, it's been such a challenging time globally in the last few weeks. How has that changed your strategy? And Rishabh, I'm actually glad that you're in Bombay, because I know you shuttle a fair bit between Dubai and India. But it's good that you're here.
No, thanks for having me, Chandra, and pleasure to be here at the Moneycontrol Global Wealth Summit. I think from our end, I think these changes have happened here and now. So it's difficult to really plan in terms of with all the geopolitical shifts taking place. I think the here and now issues will be on crude and how that impacts overall businesses. Unless you're in QSR where you might get impacted. I mean, I talked a little bit more from a consumer lens. So that's what I look at. I'm sure in other industries, there will be different issues that will crop up. But at least those are the here and now issues for us. But I think in terms of you're asking in terms of staying relevant, what are we doing? So at least from our end, in terms of strategy, we're just being more relevant in terms of the quantum of capital that we're investing into the businesses. So we're going deeper. We're taking more stake in the businesses. And so by taking more stake and being more relevant, we're able to influence the founders more. The amount of capital that you have on the cap table, that is proportionate to the influence that you make with the founders, is our belief. So I think that influence itself makes a difference, and having a seat at the table in terms of just influencing really impacts the potential overall direction of the business. And if we believe that we have the experience, then we can actually add that value to the founders. Of course, the founders are driving the show. We are venture capitalists, so we're investors. So we appreciate founders as well. And founders are driving it. It's their blood, sweat, tears with our capital. So, I mean, that's how we look at it. But I think that, just overall in terms of thought leadership as well, we do a lot of engagement with founders to actually drive, value and give perspective. So, for example, we had 3 weeks back, we had a entire masterclass on content is a new distribution, and how content is changing the way in which the distribution moat is getting killed in consumer. So,
and will consumer continue to be a sweet spot for you, because you've been investors in, Mama Earth, Nykaa, Sleepy Owl, or Sleepy Cat, a whole range of D2C and consumer businesses. So will that continue to be your sweet spot?
Yeah, 100%. That's all we understand. We don't understand anything else.
What about you, Deepak? If I look at Catamaran, again, very diverse portfolio, from insurance to deep tech. In fact, one of your companies listed recently, SEBI Mechatronics, which is a deep tech company based in Pune, founded by an IIT Bombay professor. So where do you lean towards?
So thanks for having me and all of us here, Chandra. I think just to the first question on, what's our reaction to all the volatility and the chaos in the world today? Look, we are test match players, not T20 players. We watch the T20 and clap. but really the idea is really long term. And so these volatilities will come up and down, and you have to go with probably three things. One is, like Rishabh mentioned, if you have conviction in what you bought, whether in public markets or private markets, then just wait it out. One of the things we try to evaluate is whether the company is resilient enough to handle such short-term, volatility. The second really then comes down to asset allocation. Do you have enough liquidity that you can, manage investments when there is an opportunity, right? So it comes down to honing your ability to have the right allocation so that you can turn some of these events into opportunities. So for instance, today, we are really analyzing how much liquidity we have or be able to generate quickly. So if the market drops, then you use this as an opportunity to enter because you're really thinking long term, right? So that's the kind of approach that we have taken. And yeah, we are glad for some of the IPOs. We've had 2 IPOs in the last 2 months, 3 months, I would say, which is again testament to the quality of those founders.
And will you look at setting up perhaps an overseas office for Catamaran? Is that on the cards? Do you already have plans in that direction?
Yeah, I mean, we are looking at that more from a point of diversification because most of our capital is here. But you have to find the right structures and the right partners to do that. We have made attempts to do our own, but that hasn't come through, but because of the way we are structured. But if you find the right partners in who think like us long term, the right amount of risk and safety that we're looking for, that's an opportunity, yes.
Great. Venkat, as you know, when I introduced you, I said the newest family office in the block, managing Mr. Uday Kotak's wealth. You are what, 15 months old?
About 18 months.
18 months. And one of your first big moves was actually to acquire a consumer brand in the US, which is a very different approach. So tell us about, where you see opportunities as a family office.
Sure. First of all, thank you for hiring me, and good afternoon to all the audience here. I'll take one step back and just explain to your audience. First of all, the term family office. Each family office will have a different objective. So it's not a homogeneous pool of funds, and hence, while in some parts family offices would have somewhat similar objectives, but if you scratch the surface, everybody has a different goal. And in our case, because of the kind of peculiar nature of the family office, that we have a large exposure to financial sector. That constitutes the bulk of the family's assets. And that financial entity by itself has significant exposure to everything that you can think of in financial markets, whether it's public markets, private equity, everything related to, and it's a big play on the Indian economy and the Indian financial sector. So that's our starting point. So, while many family offices may be trying to solve for a certain amount of financial return for the corpus that the family has entrusted with them, in our case, we have a significant exposure to the markets in any case. So when we thought about what should be our strategy, there were 2 things. One is diversify away from financial services. And again, unlike many of the big business families and industrialists who tend to have, because of business reasons and the nature of business, tend to have capital outside, which acts as a natural diversification. In our case, our founder, our principal, had 0 capital outside India. So we are entirely INR, entirely financial services. So from there, how do we move out? So the diversification objective was non-financial services and, to the extent possible, non-INR kind of investments. So that's how we kind of thought about it. So that's on one part. The other part was, again, we didn't want to be in multiple small investments, which we have to manage. the approach is that, look, we want to be business owners. Like we have investment in the bank, we want to make a handful of investments that we can practically own forever. So that is, a business owner's mindset than as an investor mindset. So that's our starting point. And the investment that you referred to happened to be one of the opportunities that came along because we have been talking to the bankers, and we found the target to be extremely attractive. We got an opportunity to acquire almost 90% of the company, and it's in a better for you snacking kind of product.
Will that continue to be the sweet spot, non-financial services,
Yeah.
non-INR?
Absolutely. No, not INR. We'll of course be looking to make investments in India, but it so happened that this one came up
Basically,
ahead.
if you're not doing anything in financial services, go to...
We won't, by mandate, we can't do anything in financial services. So that's our starting mandate. But so non-financial services, business ownership approach with a value investor mindset. That's the way I describe our objective.
Shekhar, if I look at Clay Pond Capital, out of 5 startup deals today, at least 2 will have Ranjan Pai's name somewhere. Now his name is also there when it comes to IPL teams. So hopefully, I don't know, RCB, are we going to see Ranjan Pai there? Fingers crossed, toes crossed. But how has it been for you? Because you've taken really large stakes in some companies where you have a controlling position. And these are not easy companies to run or turn around, from PharmEasy to Akash. But on the other end of the spectrum, you also want to invest in new age startups, for example, like a River EV, which makes EV bikes. And are you also an LP and fund? So is it going to be a diversified strategy?
Yeah, it's quite diverse, as you said it yourself. Yeah, the two ways we're looking at it, right? First is the sectors that we understand well, given our background.
Yeah.
So sectors where we understand well, we're okay to take very large concentrated bets, control stakes, and you've spoken about some of those investments. And then the second part of it is...
Where you're promoter.
Sorry?
Like you're the promoter of Akash, promoter of PharmEasy.
We're not promoter of PharmEasy, but Akash, yeah, we have a control stake there. And we also have control stake in some medtech device companies. So in spaces where we understand, we have very clear opportunity view, we are happy to take those risks. But the rest of the fund, we also are a very active growth stage investor, and you spoke about some of those investments as well. There, we like to participate at a certain stage. We are sector agnostic, but we are more stage specific, so which is coming in at growth capital, maybe 200 to 300 crores of check size. And there we are fairly open and operate like any other private equity fund. And yeah, I mean, coming to the recent volatility, by definition, we are long-term oriented, like Deepak said. It doesn't impact us.
Deepak said it's a test match approach, not a T20.
Yeah, rightly said. But that said, it impacts our portfolio companies. So in a portfolio like ours, we have an airline company and we have a defense company. And the impact is very different on both of them, given what's happened in the last 4 weeks. So for us right now, the focus is on supporting our portfolio companies, for them to deal with the situation in the near term, than for us as a fund, we continue to operate the way we have always operated, which is to take long-term view.
Right. I think earlier my colleague Surabhi did a show of hands in the room. Will you buy the dip or just stay away from the markets for now? And I think people on this side of the room said it's a big opportunity to buy. So from a family office perspective, are valuations more reasonable now, both in the public market and private market? Is it an opportunity to double down, Rishabh?
I think, not that I'm an expert on public markets, but I think across the board, it's still, the valuations are definitely much higher, and definitely a lot of overvaluations taking place across small and mid caps, for sure, large caps as well. If we look at a 20-year or even a 10-year the mean, it's still one or two standard deviations above that. So
the correction is not yet sort of happened.
Not yet, at least. Not that we see it happening. I would love to hear from the others, but not that we've seen that happen. It's not sort of impacted our portfolio in any way. But I think it will come. Given all the uncertainty geopolitically right now that's going on, I think it's a function of time where it's going to happen. And you'll see that dip coming in the next, I don't know, 3 to 6 months. Difficult to say, but next 3 to 6 months, at least in the public markets. For in terms of the private, again, if I look at consumer itself, as in Marico's been an acquisitive player, but we've done deals at really good valuations. So that's augured well for us. But then you have multiple, you have companies who are buying businesses at 6x multiples. I think those take the markets, and founders want those high multiples, which again, I don't think that will augur well for the market either, because even for a listed company, you have to build into those multiples. So if you don't build into that, then you'll get impairment. So I think it's a challenge when you buy, even though like consumer good companies, we have big treasuries, and we can afford to buy those companies at 2,000-3,000 crores or whatever. But still, the challenge is that once you acquire it, how do you build it up to that level at that pace? So the pressure is on the company to actually then perform and make that good and make that happen. And I think that's the challenge, which, I mean, sometimes founders just see the market and say, okay, fine, this is 6x multiple and this is what I want. But in reality, it's very difficult to sort of come into those valuations.
Got it. Deepak?
No, I think, if you look at public markets first, I think like somebody said on the previous panels, there are pockets in which you can buy. So what the approach we take, of course, there's a large swath of stocks that you analyze and keep ready, and you wait for the moment to buy them because you have conviction in the stock. It's just that valuation might be expensive today, but again, these are opportunities. And so rather than painting a broad brush of mid-market, small market, it's like there are pockets, there are specific companies that you can acquire today at a reasonable valuation. On the private market side, I think like Manish said in the previous panel, private markets take some time to catch up on geopolitical and these kind of risks and to mirror the public markets. And so what we are seeing, at least until this whole crisis happened in the last week, there was still a lot of money in the system. And so in late stage growth and late stage where we are focused and pre-IPO, if there are good quality companies, there is a lot of money flowing to them. Right, so it's a very concentrated flow of money, and therefore the valuations tend to be expensive, right? Pre-IPO, and so you have to be very careful at that juncture. But in early stage, for instance, if you take early stage AI, deep tech, there we are not seeing really a big run-up in valuations like you're seeing in the Bay Area, for instance, right? You're seeing pretty reasonable, and founders are also not really looking for that much of valuation uptick at the start. So I think it's kind of mixed depending on which asset class and at which stage you're looking at these things.
So private markets, you think, will still have to catch up?
Yeah,
there is a lag effect.
Of course, we have to see now what happens because as you probably most people know, in the private market, there's a lot of money coming in from the Middle East, from the GCC.
From the sovereign
what
funds.
Is going to be the impact of that on the amount of capital flow into private markets and late stage in the PE markets in India, we'll have to see.
Great. Venkat?
On the public markets.
In terms of the overall valuation expectation.
Look, the correction has been sharp, and hence you will always find the market a little bit more attractive today than it was, say, 3-4 months back. But it's not become cheap in an absolute sense. So we are far away from becoming attractive on an overall basis. But I would say the mid and small cap, at least a 10-15% at the bottom, have become literally very, very attractive. So there is a sharp correction in mid and small cap in specific sectors like chemicals and engineering and all of that. Combination of tariff fears, raw material related disruption and all of that. So there is a pocket of market which has become attractive, but I don't think the market as a whole has corrected enough to make it attractive. From a private market point of view, I don't think there is going to be any dent immediately. The expectations in the private market are set not on a daily basis. Over the last 3-4 years, entrepreneurs have seen how well the public markets have received IPOs, and hence the valuation expectations are very high. Even today, even in this market, some of the IPOs have been priced at a level where you would hesitate to kind of invest, however good the company may be. So I think the time it takes for the message to reach the private market is still some time away, not yet there.
Got it. Shikhar, since he mentioned IPOs, I have to ask you, if you look at all the new age company IPOs since last year, except for maybe a couple, which is Grow and Lenskart, almost all of them are below the listing price. Does that make it hard for the next batch of new age company IPOs? And if I look at your portfolio, I think Zepto is a big, is one of the most anticipated listings this year, apart from PhonePe, when I look at the startup space. Again, does that make it difficult? Do you see delays in some of these IPOs like Zepto, PhonePe, till the market sort of becomes better?
Yeah, I think the panel before us also addressed this question that it's not given that good companies cannot IPO in this space, but given the trajectory of what the other companies have gone through, clearly everyone, both the companies are more aware now in terms of what they need to deliver in the first 1 to 3 years once they list. Markets can be unforgiving at times. And even from an investor perspective, people who are participating in pre-IPO are, I guess, now more aware of what it takes to type that whole investment from getting in to getting out, because they're lock-ins, the companies themselves will go through a few cycles. So I think all of us are learning, from the rush that, the companies know what performance demonstration track record they need to have even post-listing. Markets can be very tough. The investors know what are the reasonable expectations to have when they participate as an investment in a company which is closer to an IPO. And maybe the big change is the investment horizons have to be very clear when we look at an asset which is close to an IPO. But that said, I think good companies will continue to do good, as cliched as it might sound. And in times like this, the best companies get separated out from the not so best. So the good quality assets will always attract right capital, right investors, and that's what we're in the market for.
Great.
Chandra, if I can just add 2 points to that. See, I think one is companies coming from this VC, PE, and going public is a relatively new trend in India, right?
Yeah.
So we are also evolving and learning. And I think public markets also will take some time to understand how these companies perform. And the advice we are giving to our founders is that you don't dress it up for an IPO, right?
Don't do any window dressing.
Because the market
or,
will recognize that in 2 quarters. And then you'll have a problem, right? So that is one piece that we all have to, both as investors and as companies, we have to keep a watch out for. I think the second thing there is that, well, I lost my train of thought, so I'll let it go, yeah.
We'll come back to you, Deepak, when you remember. But we have 3 minutes, so I'm just going to do a very lightning round. Rishabh, one sector that you will stay away from this year?
Stay away from?
Yeah.
I mean, I'm so focused on consumer that I stay away from
That's
most
like
sectors.
the easiest answer, anything non-consumer.
Non-consumer.
No, I said that's the easy answer for you, non-consumer.
But I think the buzz is on AI, and there's a lot of madness like globally on AI. So I think that's something that, if you really don't know it, then, it's very easy to say, put money into
anything that has .ai at the end.
Pretty much.
Okay. Deepak, one sector that you will stay away from?
We've stayed away from for a while on lending.
From?
Lending.
Lending, okay. Venkat?
I told you BFSI.
Lending, BFSI. Shekhar?
I mean, I wouldn't say sector, but we'll stay away from the hype. There's a lot of noise around, and it's very, very
hype
important.
is a very broad term.
Yeah, very important to stay disciplined in our process. But yeah, I mean, we're a sector agnostic fund. There's nothing that we'll stay away from as long as opportunities exist. But I agree with what he said that, what AI does to many of these industries is an evolving story. And that's wherever we are not clear about what the impact of AI is, we would want to wait and watch.
Got it. Who has the toughest boss?
I mean, I did have the toughest boss when I was working with my father. Now luckily I've got enough autonomy. So, he's not as he used to be earlier on. But I mean, I think I'm in a good space being a family office because I'm answerable to only the family and not to other investors. So I think, you know, as a family office, at least, because it's my family and I'm running the show, you know, our long-term horizons are real, you know, compared to a VC or a PE.
Which would have a 5-6 year horizon.
No, more than that, not
More
5,
than
6
that.
years. You should have like 10-year horizon, right? Because a PE VC will have a 6, 7, 8 year horizon, maybe even 10 years. So how do we stay the path? And that's the differentiator, right? Why should a founder take our capital? They can take venture VC or PE money. So they should take the reason to exist, and the differentiator is family office because of long-term patience. And I think that gives us the performance pressures less. And because VC and PE has performance pressure, of course it has discipline as well because of that performance pressure. But because we don't have that, I think, you know, I was at all the annual investor conferences there in Bangalore last week, and $450 million fund, the global investors were asking them, it's year 2 of that fund, and the global investors asking them, when can we see liquidity in year 2? So you know, it's funny that, you know, liquidity is just, you know, they want to see very quickly, they want to see DPI, and we are able to stay the course and you know, exit even post IPO, which is what some luxuries that some VCs or Ps may not have.
Got it. 10 seconds, Deepak.
Well, you know my boss probably better than I do. No, but you know, I must say the family has been very generous. We're trying to build Catamaran as a professional investment firm. And so the family's involvement is more to ensure that we can build a very long-lasting firm. So it's more about the processes and the way we take decisions rather than the decisions that we take ourselves.
Got it.
So I think that's...
Look, there is this quip that I'm a simple man, I'm easily satisfied with the best. So, you know, I have that kind of requirement. But jokes apart, I think the key requirement for any professional is clarity of mandate. As long as the mandate is clear and the goalposts are not shifted, you're good. I think that that's good enough.
Okay.
I don't think anyone defines Ranjan as tough. You know, he's as good as they come. So, you know, but that said, it's very important for us as a family office to take his culture and make sure that we are reflecting that culture in everything that we do. You know, the advantages that family office has will always remain, that you're faster in decision making, you're flexible in terms of in your investment thesis, you can be. You have a longer term investment horizon. We are able to connect with the founders and their journey of building business better because of our background. So we need to make sure we're taking that goodness. But as we go forward, we also want to make sure that, you know, we are truly capturing the aspirations of our promoters, Ranjan, in terms of what kind of wealth creation, wealth preservation journey he wants to go on, which means we have to become multi-asset, and which means we have to build our competencies, processes, discipline to be able to do that. So that's a balance we have to find.
Great. On that note, thank you all very much, Rishabh, Deepak, Venkat, and Shekhar, and hopefully we will see more and more money coming from India's family offices this year. Thank you very much.
Thank you. Thank you, Chandra.
Thank you. Yeah, thanks. All right, thank you so much for everyone for giving us a rare window into how India's private wealth is being managed, debated, and deployed. And thank you, Chandra, for leading and driving this conversation. But this brings an end to our morning sessions. We'll now take a break for lunch. Please join us in an hour for more insightful discussions. Thank you, everyone.